offering the region's battered tourist industry a chance to salvage the summer. EU negotiators have agreed on the introduction of certificates that will allow quarantine-free travel within the bloc. The coronavirus documents will offer proof their holders have been vaccinated, have recovered from the illness, or have a recent negative test. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there has been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada is going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
In my conversation with President Netanyahu, I commended him for the decision to bring the current hostilities to a close within less than 11 days. I also emphasized what I've said throughout this conflict. The United States fully supports Israel's right to defend itself against indiscriminate rocket attacks from Hamas and other Gaza-based terrorist groups that have taken the lives of innocent civilians in Israel.
The President of the United States from New York City this morning. Good morning. Alongside Tom Keene, Lisa Bramwitz, I'm Jonathan Ferro. Is the price action this Friday morning? Equity futures up 11 on the S&P. We advance 0.25%. Yields are higher too by a single basis point. Your 10-year nominal yield is 163.69. In the FX market, euro dollar 122.35, and in the commodity market, just briefly, 62.88, up about 1.5%. If we switch up the board and have a look at DIA in the pre-market, up about 0.8%. Coming into today, up by about 32% on the year so far. Yeah. So that's quite a run through 2021 so far. And they lift the outlook this morning. The guide, the outlook looks better, Tom.
John, I'm going to fold it into what we heard from Gregory Dacko. Too short a visit with Mr. Dacko of Oxford Economics. But his optimism there of 10% GDP folding into 7% GDP and then into a good 4% number. Those are the kind of numbers that fold right over to a worldwide John Deere doing better.
Yep. So Goldman just put out their VIP list, Tom, which is basically the list of the companies that the hedge funds hold and where they're most concentrated. The big 5 holdings are still the big tech players, but the 15 new VIPs, most of them cyclical. So here are some of the names: Citigroup, General Motors, Freeport-McMoRan. That's where the money started to shift away from the big tech players. But still, you know what the number 1 holding is in this list? Facebook. Lisa.
Facebook, I would not have guessed that.
27% of monitored hedge funds own Facebook shares. 57% of those hold it as a top 10 position.
Kind of amazing to see this.
One of the reasons there is Emily Wilkins will spend 12 hours tomorrow on Facebook. She joins us now, Bloomberg government reporter in Washington. Emily, I lost Facebook like 3 years ago. I just said enough of this foolishness. I'm going to ask you what you're doing with it. What I'm going to ask you, Emily, to me, it is a weekend in May for Washington to recalibrate. Greg Villiers mentions moments ago the tax game and the tax forward view is in shambles. There's been lots of distractions, including Israel. How do you presume Washington will recalibrate into the summer?
Well, Tom, you're making a really great point here. I mean, we heard yesterday from Congressman Peter DeFazio, the head of the House Transportation Committee, that a markup that we were expecting to be critical to President Biden's infrastructure bill, that was supposed to be held next week. Now it's not going to be held until late June. And so you're starting to see these delays in the process as lawmakers realize just, I think, how complex this plan is. They're still trying to figure out whether it can be bipartisan, whether they need to go it alone. And the clock is really ticking here because certain deadlines they have to meet before this upcoming fall. And then, of course, 2022, when the election stuff really gets underway, it's very hard for Congress to legislate on anything.
Who in the Democratic Party, obviously the president, is going to be the one to corral them into some form of consensus to move forward as the Democrats recalibrate? Is it Speaker Pelosi? Are you watching Senator Schumer? Is it somebody I don't know?
I think, Tom, you hit on the exact two. It is Speaker Pelosi. It is Senator Chuck Schumer. Of course, I think they are right now pushing the White House to sort of make a decision here. Chuck Schumer has already said that he is worried about if Congress waits too long to start actually moving on something, if Democrats wait too long to have Republicans give a yay or nay on whether they're going to go at it with Democrats, then this is going to be more time that the Democrats don't spend. I was speaking with someone yesterday on the Hill who was saying, look, this plan, we need it to pass, and then we need to start actually seeing productive results before November of 2022. So when lawmakers go up for re-election, that they're actually able to point to shovels in ground saying, look, we passed this bill and now things are actually getting done. The longer they wait, the longer it's just a proposal and none of the voters in America are actually seeing any changes.
Emily, which raises the question of how much ground the Democrats are willing to give up. And I wonder, as we take a look at that 15% minimum tax globally that the U.S. is currently proposing on corporations, whether that is giving a lot of ground, how that's being received by fellow Democrats after initially proposing a 21% global minimum tax rate.
Yes, Treasury Secretary Janet Yellen has called that 15% proposal the floor. It's clear that she's hoping to be able to negotiate up higher, although I know you guys were just talking about the fact that 15% is still higher than what you're seeing other countries propose. Look, we are seeing sort of the rubber hit the road on this tax plan. Yesterday, Bloomberg reported that Richard...
Hello, ladies and gentlemen. Are you ready to trade today Japanese yen? I'm looking to sell Japanese yen, sell short, and I'll tell you the price I'm looking to sell. It's probably will fill right now 108,680. Okay, the price I'm looking to sell, I'm entering position at 108,680, just above this. It's not far away. So if you're looking to trade right now, please, you still have time. I am about to open short position on Japanese yen. I'm still waiting. Okay, I'm still waiting. So let's see. Let's wait. Hopefully it will get filled. Okay, I'm in. Position open for Japanese yen. If you had time, if you decided to follow my trade, stay with me and we will complete this trade. We will collect the profit from this trade. Okay, it's look like for you guys, it's not about trading, it's about collecting profit to find the right pairs. You have to wait, of course, for a while. We're not gamblers, we're traders. So you need to wait for a while, but at the end of the day, you will, when you enter position, it doesn't really matter if it's long position or short position. We all, our all position, we entered a winning position. It means we will make profit on it. If you want to get the strategy and to find out how we trade, you need to go to companyeye.co.uk and you will find all the information. You need to get the strategy and you'll start trading not only pairs you can see on the screen, but you can start trading other pairs as well. Okay, I'll speak to you later, guys. Stay safe.
Orders due to forced downtime. Sounds familiar, doesn't it? You can just take that quote and insert any country right now in Europe, in America.
Yeah, and this is really the prevailing theme, and really the unknowns include how long this is going to last, how much this will crimp growth and supply, just to also give you a sense of how much this is jacking up prices. The price subcomponents of the PMI in the Eurozone for the manufacturing sector showed that almost 90% of companies had to pay more for their intermediate inputs in May.
That is the theme right now, worldwide. From New York City this morning, good morning. Alongside Tom Keene, Elisa Abramowitz, I'm Jonathan Ferro. Equity futures are advancing 13 on the S&P. We're up about 1/3 of 1%. In the bond market, yields higher by a single basis point to 163.69. In foreign exchange, getting comfortable with a 122 handle this week, 122.33. There we go, Tom. And crude higher, up by 1.6%, $62 and about 93 cents. More still to come from New York. This is Bloomberg Surveillance.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Expect clear, concise conversation on Bloomberg Surveillance.
There's no vowels in a digital future.
Come on, John, I just think it works.
It works. We've beaten
this to death.
Watch weekday mornings on Bloomberg Television.
Stocks are positive. The dollar's weaker for a second straight day. 89 handle on the dollar index, getting comfortable around those levels, and on euro dollar in and around 122. That's the story of foreign exchange. Here's the story of the equity market right now, up a third of 1% on the S&P. Coming into Friday, down just a nudge. That's Tom's word of the morning. Just a nudge. Down just a little bit, TK. Yeah, the Nasdaq right now down by about a third of 1%. The Russell up by about a half of 1%. The data out of Europe, pretty tidy. I'll talk about that in just a moment. If you switch up the board and get to the bond market, 2s, 10s, 30s, your 10-year nominal yield has done pretty much nothing. Through the week, we've had some movement, but on the week, going nowhere. 163.35 on 10s, 234 on a 30. Your nominal yield has been stable on the week. Break-evens have come in because real yields have started to push back out. And that's the calculation for break-evens. It's the nominal minus the real and a gap in between. And that spread's been getting wider over the last year or so, Tom. And everybody's always talking about it. Break-evens, inflation expectations. Every time you get a move that's not nice, it's always inflation. It's inflation. This week's been about real yields, Tom. Real yields starting to come back a little bit. And I know you've been on top of that too.
Yeah, the real yield story to me is definitely there, John, and I think it comes up to the combination of economic data. I'm going to again go back to Greg Dacko as an uber optimist. What, John, does real yields do if you get the uber optimism?
I don't know. You get a reprice if you get a taper? Is that what we got a little hint of this week?
That's the consensus, which all my radar's up when the certitude of taper tantrum I really have trouble with.
This summer could get a little bit more interesting. Switch up the board and finish on this. Over in Europe, have we got to this place where the story's really well known? In Europe, the data was terrific this morning. Fantastic. Yes. What do yields do? Bunds come in 3 basis points in Italy, down about a basis point in Germany. We've had a lot of repricing here, despite the fact we hadn't seen the data in Europe perform the way it had in America. Right. Now we're starting to see the data. You can see it in the upside surprises. Have a look at the City Index, the Bloomberg Index in Europe. It's going this way, up. In the United States, it's going this way, down. But this story in Europe has been getting priced through the year, Tom. In bonds, more recently, and in equities over the last 6 months. You've seen the bank stocks absolutely rip over the last 6 months.
John, I'd really fold it into almost a cultural issue or social issue, the drought, the grimness of the vaccine in Europe, and that has been sharply reversed. And, we see the enthusiasm, particularly in Germany in the week. John, with the festivities in Bitcoin and with our good guest coming up, I want to do this board with John Farrow right now because it really goes to what we've tried to do with Bitcoin, which is Bitcoin pro and Bitcoin anti-people. Bring up that board if you would. All right, now, John, I'm sorry, gold, there's the movement, 2% on the week. There's one of the European great pairs. This is incredibly important for Eastern Europe mortgage pricing, some kind of stasis. And there's a volatility of Bitcoin. John Farrow, is Bitcoin a gold or currency equivalent?
Before we get to Bitcoin, can we have a look at that Swiss franc foreign cross that you've just put up,
Yeah.
TK, coming out of the last crisis, people will remember there were a lot of mortgages taken out in Eastern Europe in Swiss francs. And when we got that adverse move away from what you were denominated in and what you earned your money in towards the Swissy, Tom, some of those mortgages got absolutely hammered. I haven't looked at that cross for a long, long time.
I know you'll tear up on it, John, but I wanted to bring it here. Right now, Rebecca Patterson joins us. We are thrilled to have her with us. She's with Bridgewater, Director of Investment Research, but far more is her time on the street, bringing holistically together the foreign exchange market with everything else out there. Rebecca, wonderful to have you with us today. On Bitcoin, what did we learn this week? I put up there some of the dynamics, the silliness of it being a gold equivalent or a coin equivalent. What did we learn?
I think we got reaffirmation that it's a speculative asset and it still has a long ways to go to become a gold equivalent, to become a proper storehold of wealth, something that you can count on to have purchasing power over time that's going to have stable and relatively low volatility. This was not a low volatility week or so for Bitcoin, quite the contrary.
Rebecca, do you see a generational divide between certain age groups who believe this is the new gold and other age groups that just do not?
Anecdotally, yes. Anecdotally, it does seem that people who are looking for alternative sources of cash, if you will, you do have a bit of a younger generation bias towards the cryptocurrencies versus gold. But to me, it's not the generation as much as the retail versus the institutional. The money that's going into Bitcoin and other cryptocurrencies today is still largely retail. Of course, you're getting a few more corporations, you're getting family offices, you're getting some hedge funds, but the large institutional money that's thinking about, do I want this as part of the diversifying assets in my portfolio to protect me from drawdowns, from bad periods of market stress? We're not there yet. It might get there over time, but it's not there yet. So this is still an asset that I think is primarily one to be used for return and speculation, not to hold.
Over time, though, Rebecca, do you think that investor conditioning kicks in? Many people will ask us when they're not familiar with financial markets and macro, why does the yen do so well when things get bad? And there are various ways of explaining that, but one of them is it just does well. It's worked and has worked historically. Do we need to be conditioned by this somehow to start believing it a little bit more?
Well, I think over time, you could see that environment come together. And there's a couple things I'd be watching. The big one right now is the regulatory ecosystem. It's very immature still for cryptocurrencies. And after the Colonial Pipeline hack paid for with crypto, the ransom was paid for crypto, I think you are going to see regulators in the U.S. focusing more on this, trying to make sure there isn't illicit activity, trying to increase transparency. That might make some holders of Bitcoin not want to own it anymore. They're there for the anonymity, but it could create an ecosystem that gives more credibility to it, more encouragement for large institutional players to come in. If they come in and you have another source of liquidity there, that could bring down volatility over time. That's the positive flywheel that I think could change how Bitcoin and perhaps other cryptocurrencies are perceived. Obviously, there's the environmental issues too, which are clearly a problem for some investors. I think those things need to get addressed and the volatility needs to come down. But if those things can happen, I think this could evolve into some type of digital gold, if you will.
Rebecca, I want you to elaborate on the environmental concerns because Elon Musk of Tesla highlighted this, and you highlighted this in a recent research report showing that Bitcoin uses up more energy than, say, even Switzerland. When you take a look at the energy consumption, it's basically a nation unto itself when it comes to this area. Can this be solved? How big of a concern is this for certain investors?
Well, increasingly, investors are focusing on environmental and other ESG issues. So it is an increasing concern for a lot of large institutions. There are ways it can be addressed. You can see changes in the technology used in Bitcoin, for example, that could reduce energy usage. You can see the type of energy used, more of a focus on renewable energy. That could also be a positive trend. There's also another option here, which is that another cryptocurrency that has lower energy usage, but also some of the positive characteristics like limited supply, you could see that supplant Bitcoin. Just because Bitcoin is the dominant currency today doesn't mean it'll always be. So I think there are some different paths, but over time, it's going to get addressed one way or another.
Meanwhile, Rebecca, I want to pick up on something that John was talking about, because I know that this dovetails into the inflation call that Bridgewater has had, this whole cash is trash and that Ray Dalio was talking about, but moving forward, that inflation is going to be more of a threat. What do you make of the move recently lower in longer-term break-even rates? Basically, longer-term inflation expectations have come down even as we get this robust data.
Yeah, I mean, this is such an unusual time, right? We're seeing the biggest U.S. boom that we've had in decades, and we have so many different cross currents given the reopenings coming out of the pandemic, demand rising faster than some supply can meet it. And you just mentioned that a few minutes ago in the European PMI data, that it's hard to have a high degree of confidence how this is going to play out. But as we look at the year or so ahead, we see a decent amount of risk that inflation could keep rising. It's already rising, but stay higher for longer. And part of that is the supply taking a while to catch up with the increasing demand. And part of it is more structural forces. You know, globalization, which has helped reduce inflation for years, that's been plateauing and could possibly reverse a little bit. The trend towards capital over labor, that's starting to reverse a little bit as you see higher wages, higher minimum wages, et cetera. And so if you see some of these secular forces slowing or reversing somewhat, and these cyclical forces, we think you could be in a slightly higher inflation environment. So the day-to-day moves aside, I think you want to be looking as an investor, does my portfolio have enough protection if that risk becomes reality? And this isn't just, as the Fed likes to say, transitory inflation.
Rebecca, I want to get in trouble with Ray Dalio, so I'm going to ask a rude question, and you're such a pro, you'll give me an honest answer. Right now, stock-bond correlations are really quite odd. That goes into rate parity strategies and such. What is the duration, the timeline of this odd correlation where it begins to affect portfolios? We're hearing short-term, no big deal. When does no big deal become a big deal?
So, Tom, I don't think that's a rude question at all. I think you're highlighting a couple things that are worth unpacking a little bit. First, when we think about risk parity strategies, all weather, which is our strategy, it's a strategic long-term asset allocation. What we're trying to do is get rid of some of the volatility that can come with changes in economic environments, growth, inflation. And what that allows us to do is get more steady returns over time, and then we can compound that, which is, as Einstein said, isn't it the eighth wonder of the world? So that's a very different strategy than, say, pure alpha, where we're really focusing on uncorrelated return streams that are over shorter time periods. It's more tactical. For folks who are thinking about a risk parity strategy, remember, it's never been determined on one asset or one country. It's going to be a balanced mix of assets. So even if bond yields rise, there are going to be other bonds that are still attractive. China, for example, the 10-year yield there is still 3%, much more normal policy mix going on. And then you're going to have other assets that are going to give you that diversification and that balance no matter what the environment is. But the other thing, Tom, that I think is really important that you just said is about correlation. And I think, every 60-40 portfolios over the last couple of decades have just been able to sit back and let it roll in. You've had rising stocks and falling bond yields. And today there is a chance that you're going to see that relationship break apart. And you need to understand why that's happening and then what you do about it. If we think that relationship is breaking apart in part because of inflation, then you want to make sure that you don't have too many bonds. You want to make sure that you also have other assets to protect you against that risk, whether it's gold, which has been recovering nicely recently, inflation-linked bonds, even equities that give you more of a steady cash flow over time that aren't going to be as vulnerable to that duration issue.
Rebecca, always smart and always enjoy your contribution. Rebecca Patterson there, Bridgewater Director of Investment Research. From New York City this morning, good morning. With Tom Keene, Lisa Brambitz, I'm Jonathan Ferro. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. President Biden says the U.S. will help Gaza with humanitarian aid in the wake of that 11-day conflict with Israeli forces. The ceasefire brokered by Egypt took effect early today. Israeli warplanes and artillery pounded Gaza whilst Hamas militants fired rockets at Israel. At least 232 Palestinians were killed. 12 people were killed in Israel. The Fed is now looking into a digital dollar. Chairman Jerome Powell says the central bank will publish a research paper and seek public comment on digital currencies. The focus will be on how a digital dollar could improve an already safe system. China is already moving ahead with a digital yuan. Tesla CEO Elon Musk may have set his sights on Russia. In a virtual conference today, Musk said Russia is amongst the countries where the electric car maker potentially could build a factory. He also said there should be more dialogue between Russia and the US. And Apple puts its star witness on the stand today in that antitrust trial with Epic Games. CEO Tim Cook is scheduled to be the last person to testify in the courtroom in Oakland, California. He's expected to argue that Apple's rules for its App Store ensure a seamless user experience and that developers can make good money. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
We don't want to declare victory prematurely, but if we can get the 70% of adults vaccinated with at least one dose by the 4th of July, the way the president has set the goal, I think the chances of there being a surge or a rebound is extremely low. That's the reason why we want to continue to get people vaccinated.
The message from Dr. Fauci there from New York City this morning. Good morning. Alongside Tom Keene, Lisa Bramvitz, I'm Jonathan Ferro. Counting you down to the opening bow with futures looking like this on the S&P. Up 11 points, we advance 0.25% on the S&P 500. Just a little bit softer, lower on the week on the S&P 500. In the bond market, yields unchanged, call it a basis point higher. We're at 163.35. And euro-dollar muted price action here, TK. Euro-dollar 122.27, unchanged on the day.
Then the VIX 19 to 27 comes back in with all the nudge churning of the week. 20.64 on the VIX gives the bullish feel of this morning. What we've tried to do for, 14, 15, 16 months in a recovering America is bring you the smartest people we can find, the adults of medicine in this terrible pandemic. One of those would be Stuart Ray. He's with Johns Hopkins out of Vanderbilt. And what is so important about Dr. Ray's work is he has traipsed from HIV to hepatitis C, and now on to COVID. You can go back to, I love this, Dr. Ray, a stable latent reservoir for HIV-1 and resting CD4 plus T lymphocytes in infected children, a jewel from 20 years ago. Dr. Ray, you have decades of experience in the path of what we learn in a pandemic. Where are we in that sequence with COVID? Are we still newbies, or are we actually really getting a handle on this unique virus?
I think there's a huge range of statuses. We've come so far on vaccines, and we've come so far on getting the rates of infection and severity down, but we still have some headwinds, and we're learning a lot about how this virus is spread and what makes someone susceptible. So we've got a lot to learn, but I think it's amazing that we've come as far as we have in a year and a half.
How do you respond to a baseball field of 40,000 seats that will have 15,000 people in them randomly this weekend, say this Friday evening? Are you comfortable with that?
I am. I think that we don't completely understand this, but open air is an amazingly protective thing. And people still need to be careful about how they get to those seats and how they go from those seats and what they do in the corridors between the time that they're in those seats. But I think that time in the seats is probably not the riskiest thing those people will do that day.
Dr. Ray, let's talk about what's potentially riskier at a time when we're being advised that if we've gotten vaccinated, we don't have to wear our masks in most places. This is the advisement from the CDC. Is that accurate? Is that advisable given this data, given the science that you are studying?
Well, I think it's important what you hear when those words are said, because what's being said is you don't have to. It doesn't mean you shouldn't. And we have to think about the most vulnerable among us and what will help get rates low. Right now, we have pretty high rates of transmission still, similar to where we were a year ago. But we have more people who are immune, and when people are immune, they're protected from severe disease, but there are people around them who may still be susceptible, and we still need to learn about how we protect those people.
Well, Dr. Ray, can you clear up some misconceptions? Because frankly, I am not clear on just how infectious somebody who's been vaccinated is, should they contract the virus, even if perhaps they don't get very sick. What is the data? What is the epidemiological work showing on that front?
Well, we know that people who've been vaccinated have a lower rate, much lower rate of getting sick. And when they get sick, we see that they don't get severe disease or death. The problem is that we still get positives. So we're still seeing a substantial number of people who've been fully vaccinated getting hospitalized, and those people still have positive tests. So we know that they can harbor the virus, and we have some evidence that they can spread it, but it's a much lower rate than it was before they got vaccinated.
Yesterday, Dr. Ray, in a New York City that is clearly becoming more buoyant, more visibly back to normal, I heard so much talk of fear of variants, and this is from people qualified and, frankly, too many people unqualified. Do you have a fear of variants?
Well, my fear is more for the population than for the individual. I think that if you're fully vaccinated and your immune system is not impaired by medicines we give or other conditions you might have, then those variants really don't pose a great risk. So the vaccines are very effective against these variants in preventing severe disease. The problem is that these variants raise the infectivity of the virus so much that the threshold, the herd immunity threshold we need, the number of people vaccinated or proportion of people vaccinated we need to protect the population from spreading of this virus is now higher. So the more infectious the virus, the more people we need to vaccinate to get to the point where we don't get kindling of an epidemic. And so now, instead of, initially maybe 60 or 70% threshold, we need more like 80, 90% of people to be vaccinated. And that makes it harder to get there, especially if there's hesitancy about it.
Stuart, how do we know what the emerging dominant strain is if we have such limited sequencing in the US compared to, say, the UK?
Well, it's true that the UK got ahead of us on this, but we've made a lot of advances in this. And we're now sequencing more than 10% of all positives in the state of Maryland. And I think many jurisdictions have done the same thing. So we've ramped up that capacity. We have a pretty good idea of what's going on. Now, right now, what's happening is that the B117 variant that was first identified in Kent in the UK is now the dominant strain, with like 80% of infections being caused by that one. But we now see the rise of some other variants as well. And so we have to keep an eye on that. We need to make sure the molecular epidemiology is happening.
Doctor, always good to get you on the show. Come back soon, sir. Thank you. Dr. Stuart Ray there, Johns Hopkins Professor of Infectious Diseases, on some of the issues playing out right now. On the emerging dominant strain, the variant first identified in India, Tom, seems to be the concern in the UK. And I just wondered to what degree that's going to hold back travel arrangements later this summer.
What I find sobering is the pros don't know. I mean, we're all running around looking for certitude, whether it's the kids to camp or, airlines, as we talked about earlier, John. But the answer is the pros don't have a clue. They're learning as they go. We ought to have respect for that.
Always something to worry about, Lisa.
That's so true.
Without a doubt, there's always something to worry about. I'm definitely a prime candidate for that. I do want to just note one thing that really caught my eye. Taiwan saying to the United States, you want some of these chip shortages solved? Give us more vaccine. This idea of trying to dovetail directly the vaccine accessibility to some of the chip shortages that we're seeing.
Vaccine diplomacy.
Yes.
No, seriously, I mean, John, the helicopter was out this morning, so I took a car in and I talked to the driver. My biggest mystery is Japan. Seriously, I just...
how slow it's been.
I just don't... I literally don't understand it. I have to read about it this weekend.
How close are we to the Olympics, Tom?
Pardon?
How close are we to the Olympics?
We're close, and it's a raging battle in Japan. I'm not read in on that, but what I know is I would have thought Japan would have been out front on vaccine efficacy, and I think it's the opposite.
Well, Japanese Prime Minister this morning was saying he wants to hold a safe, secure Olympics with virus precautions. So he's still planning on the Olympics.
Oh, I think most people are planning on the Olympics happening July 23rd.
Yeah, coming up.
Coming up a little bit later in the next couple of months from New York. Alongside Tom Keane, Lisa Abramovich, I'm Jonathan Ferro, taking it towards the weekend. We're all looking forward to that. This is Bloomberg.
traffic.
Okay.
During the pandemic, no traffic.
Okay. Where do you see the oil market in about 20 years or so?
Non-existent.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
All this money sloshing around, these incredibly low interest rates, I think we risk an inflation surge.
If the economy stays as strong as it is, fueled by all of the stimulus that was put behind it, you get inflation.
The Fed is likely to start to shift their policy stance in the coming months.
We've never had a situation historically where the Fed has not begun to normalize rates and there's an inflation concern in the markets.
No one knows if these inflation pressures are going to prove more transitory or less transitory.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Equity markets this morning positive 10 points on the S&P. We're up by about 0.2%. Tom, we had some PMIs out of Europe earlier. Decent, better than expected. Some PMIs out of America a little bit later.
I think that's the right language, John. Decent, better than expected really sets us up for the weekend as well. What I would note, John, is the NASDAQ 100 gives you decent and better expected off the mat of gloom, the pendulum of gloom we saw, say, on Wednesday or Tuesday. We got a nice 4% move in NASDAQ 100.
The NASDAQ up 0.2%. The big test taking place in this labor market right now, Tom, the division between labor demand and labor supply. And that's been the debate once again this week.
You are dead on. It's the microeconomics of labor. That's what small business, big business is worrying about. We're going to talk about that in a moment as we went to Montana yesterday. We're going to go to Minnesota on it. But it's truly nationwide, John. And we're just going to have to see where that goes. 3.8% unemployment rate in Montana. Wow.
Real life case study playing out now, Lisa, in this country with more than 20 Republican states saying, no more additional UI. It's time to get back to work. Now, that's their view. Let's see how that works out.
Yeah, although there was a Gina Smielek tweet out yesterday of the New York Times where she was highlighting a Federal Reserve report. I know you picked up on that, John, talking about how this is just a small component to some of the labor market shortages, the enhanced unemployment benefits that people have been receiving. It is a complicated issue. The frictions are enormous as we try to restart a massive global economy all at once, John.
Let's run through the price action this morning, Lisa, starting with equity futures up about 11 on the S&P 500, advancing 1/3%. Into the bond market with yields higher by about a basis point on 10s at 163.35. Euro dollar just slightly negative. This is one you've got to try and get your head around. The data better than expected, the euro negative, down about 1/10%, Lisa, 122.19.
Yeah, try to get your head around a lot of market reaction to a lot of the data that we've been getting at, and good luck, you'll have a confusing day. I will say, you mentioned PMIs, and 9:45 a.m. we do get that ISM data from the U.S., or excuse me, market data from the U.S. The idea will be we'll get manufacturing and services information. I want to highlight once again the frictions. We can see the frictions on every front. Increased input prices, supply chain disruptions, labor shortages. Are these temporary? Are these long-lasting? Will we get guidance from companies with some of these data points with respect to how long they expect some of these factors to crimp their businesses? Then at 12:15 p.m., sort of talking about the transition of the global economy, the Dallas Fed is going to be holding a summit on technological disruptions, the future of work post-pandemic. We're going to be hearing from Robert Kaplan, Raphael Bostic, and Tom Barkin, all of the Fed, coming out, talking about what it means for a labor force with more automation, with higher skilled workers more in demand, with many more people demanding higher wages. How long lasting could that be? And today, Joe Biden, President of the United States, is meeting with the South Korean Prime Minister. The question here, to me, really is how they're going to address some of these supply chain shortages, how they're going to address some of the diplomatic issues in the South China Sea with respect to South Korea and China with respect to how they deal with North Korea. But John, interesting again to note that the first two meetings that Joe Biden held, both with Asian countries, Japan and South Korea.
That's where the emphasis is in the early days. Then next month, it's Europe. The president with his first overseas trip to the continent. His first overseas trip of the presidency, Tom. He'll be going to Brussels, I believe. He'll be going to the UK as well. I want to have a look at DEER just quickly in the pre-market, up by more than 1% in early trading, positive 1.35%, adding to the 30-something percentage point gain we've seen so far year to date already, lifting the profit outlook, Tom. Surging farm sector demand, the headline this morning from the team at Bloomberg.
Then, John, what's so important here is the guests we've got coming up. I mean, you look at the boom economy out where he lives, and he's just screaming the Deere utility tractor, the 89 horsepower. It's big, John. I mean, it's enough to get Jim through the weekend.
More CFA
but
language.
Not too big. It's not like embarrassing big like some of his neighbors.
It's nudgy.
Let's get to Jim Paulson, shall we? Standing by patiently, the Lithell Group Chief Investment Strategist. Jim, it's great to catch up as always. We've had a market in some places absolutely ripping. And as Jonathan Golub at Credit Suisse pointed out, you can have huge price gains, but still have a valuation, a multiple that comes in because profits and profit expectations are up even more. And the profit numbers have just been incredible. The earnings, Jim, through Q1, just quite fantastic.
I agree, Jonathan. The numbers on the first quarter for the S&P 500 have come in at a $200 annualized rate. I think the full year numbers on expectations right now are around 185 for this year. So Wall Street's way behind what corporations are already coining in the first quarter. If they're doing 200 rate in the first quarter, we're going to be way above $200 for the year. So it's very hard, I think. $185 is a huge improvement. I just recently looked back at coming from the lows of earnings going all the way back to 1950 and saying, how long, if you look at 1 year from the low in the earnings in the S&P 500, how much was that relative to the previous cycle's peak earnings? And most of those are down yet 1 year into the new recovery, that you're still not even back to peak earnings. If we come in at, let's say, $200, $215 earnings this year, 1 year after the low, basically, in earnings, which was the end of last year, we're going to be up some 40% almost from the previous cycle peak, which just blows away anything else we've ever done in the post-war era in a new expansion. So I think Wall Street in general and economists and everyone, companies are having a really difficult time keeping up with how fast fundamentals are improving.
Now, to the PhD from Ames, Iowa, what I'm going to say, Jim Paulson, is if you go north on Route 35 out of Ames, Iowa, when in doubt, America always has to buy another tractor. I mean, that's what we do. We're optimistic. We're out there. There's a boom economy. Dear, we need a new tractor. Is that mood out there right now? And what does that mean for the underestimation of where we are?
I think it is, Tom. I think there's burgeoning optimism here. If nothing else, just getting your shot in the arm and feeling some sense of normalcy has really elevated not just spirits, but animal spirits, I think, of getting back to work, going at it again. You certainly see everything here just booming again. Traffic, is just something that we haven't seen for a while here that you're dealing with again as people are actually going down to work. The downtown is coming back to life. You know, so I think companies are starting to reevaluate. The thing that we did here is we went from a depressionary bust to a wartime boom within less than a year. And so companies were trying to survive a pandemic and cut everything to the bone, payrolls, inventories, output, just to be able to survive. And then suddenly they were given a wartime boom. And now and as a result, we're trying to catch up, because suddenly we don't have enough labor, we don't have enough shipping containers, we don't have enough homes, we don't have enough chips. But I think given a year, capitalists will catch up. Right. And the unemployment benefits will wear out, and there'll be more labor supply, and I think we will catch up.
So, Jim, there's a question of who benefits the most from this circumstance, who could take advantage of the incredible surging demand. And increasingly, it looks like it's the big companies with respect to their ability to pay employees more to lure workers into their workforce. This, according to a Wall Street Journal article, where small businesses were complaining that it was hard for them to compete with the behemoths. And we've seen the behemoths increasingly gain share. As a stock investor, being agnostic as to whether this is good or bad for the overall economy, do you bet on the bigger companies being able to succeed more in this kind of environment than smaller companies?
You know, actually, I'm betting just the other way around. I really like small cap stocks. I think that I look at the small cap earnings. They're doing every bit as good. Actually, those earnings are coming back even faster than large cap earnings overall. So I think they have greater leverage to the economy, which is what you want to be. I think they do better in reinflationary environments where prices go up. Look, the difference between large companies and small companies have wider margins, let's say 10%. Small companies operate with narrower margins, let's say 5%. So if you get pricing flexibility on top line and you can lift prices 1%, that's a much bigger impact for a smaller margin company than it is for large margin companies. So their earnings have greater leverage to inflation, and so I think small companies are doing good, and they're you know, after many of them didn't make it, but those that are, I think, have a lot of operating leverage in their system.
Jim, good to hear from you. As always, Jim Paulson there, the Luthold Group Chief Investment Strategist. Your market this morning up by about 1/3 of 1% on the S&P, advancing about 13 points. The argument that Jim and Jonathan Golub over at Credit Suisse are making right now, TK, is that the profits have been so great, you can still have this market where you have this huge price action, but it gets cheaper. And it gets cheaper because the earnings have been so terrific. And that's the bullish view right now, at least on Wall Street.
Well, the percent change 1 year speaks to John Golub and other bulls that we speak to. I'll let you line them up. John, NASDAQ up 46%. That's a composite. SPX up 41%, 12 months trailing. The Dow lags terribly, up 39%.
Golub's at 4,600, I think, on the S&P, Tom. 41.68 right
I want
now.
to be careful here, folks. We're not trying to give our opinion. We're just framing out what people view, whether it's Paulson's economics in Minnesota or Golub's stock strategy on the island of Manhattan.
I'm catching up with Jonathan Golub a little bit later.
Oh, are you on one of your other properties?
Eastern Time.
That's good.
Yeah, catching up with Bob Michael at JP Morgan, Mohammed Al-Arian, a little bit later too.
Bring it on.
Yeah, that's the lineup later. I'm looking forward to that in the 9 o'clock hour. Stay tuned. You're going to look up and watch that from the radio booth.
No, I'm going into a meeting. We're doing a conference call on Harry Kane and what the likelihood.
I'm watching reruns of Janet Yellen.
Whilst you're meant to be on radio.
Yeah.
Nice. Tom Keene, Lisa Abramovich, Jonathan Ferro, counting it down to the opening bell. 2 hours and about 20 minutes away. Equities up 13. We advance 1/3 of 1%. In the bond market, yields unchanged at 163.18. In the FX market, euro dollar 122.17, down about 1/10 of 1% there. And crude doing okay, 62.86, up about
entry point, bit dog
%. You have a look, Tom.
I'm looking.
Do some technical analysis in the commercial.
I have the Bloomberg terminal
on radio, on TV. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. Palestinians poured into the streets of the Gaza Strip early today to celebrate a ceasefire with Israel. The Hamas militant group and Israeli forces are now observing a truce that ended 11 days of conflict. At least 232 people were killed by Israeli airstrikes and artillery fire on Gaza. A dozen died during Hamas rocket attacks on Israel. The U.S. is now calling for a global minimum corporate tax of at least 15%. That's less than the 21% rate it has proposed for the overseas earnings of U.S. businesses. Some nations had called that rate excessive. International negotiators are trying to come up with an agreement this summer. And the European Union is offering the region's battered tourist industry a chance to salvage the summer. EU negotiators have agreed on the introduction of certificates that will allow quarantine-free travel within the bloc. The coronavirus documents will offer proof their holders have been vaccinated, have recovered from the illness, or have a recent negative test. And one of the largest insurance companies in the U.S. paid $40 million in March to hackers after a ransomware attack. Bloomberg's learned that CNA Financial Group paid about 2 weeks after a company trove of data was stolen. That payment was bigger than previously disclosed ransom. CNA says the company followed the law. And Facebook is now the most favorite long position amongst hedge funds. That's according to Goldman Sachs. Sachs says 27% of monitored hedge funds own Facebook shares. The next 4 companies on that list are Microsoft, Amazon, Alphabet, and Alibaba. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
fully expect that over the coming months, these misalignments are going to work themselves out because we do have a market, and that we will get back to a full recovery, and that by the end of the year, we're going to be, in really good shape.
Good to catch up with Cecilia Rouse there yesterday, the Council of Economic Advisors chair from New York City this morning. Good morning. Alongside Tom Keene, Lisa Bravitz, I'm Jonathan Ferro. Here's your equity market up around about 14 on the S&P. We advance a third of 1%. Your bond market unchanged, 10 years, 162.84. That's your yield. In the FX market, euro dollar 122.20 negative. And if you're waking up just now, well, good morning to you. Your PMIs out of Europe, nice upside surprise, not doing much for the euro. Your PMIs out of America coming a little bit later this morning, I believe 9:45 Eastern. And Lisa mentioned the Fed speak at the top of the hour. Kaplan, Bostic, Barkin talking a little bit later. If this wasn't a technology conference, I would have thought those three might have something to say about the taper discussion in a bigger way.
Oh, yeah.
But they're not gonna, right?
Well, are they, though?
Well, let's
they
be clear. Moderating the panel is Bloomberg's Kathleen Hayes. So let's see which direction Kathleen takes this conversation.
Yeah, she'll be, okay, enough of silicon. Let's go. What's the taper story?
Hopefully.
We'll have to see what she says. Futures up 14. I'm seeing a little bit of pop to the tape, green on the screen this morning. Right now in Washington, Josh Wingrove joins us, and he's got a really twisted view coming out of Canada. And after the Maple Leafs and the Montreal Canadiens last night, we speak to Mr. Wingrove, our White House correspondent, as well. Josh, I want to compare and contrast the liberality of Canadian politics with the liberals in Washington. As we were talking to Emily Wilkins earlier, it's been a week, a jumble week, maybe a transitional week here. Where are liberals transitioning to in Washington?
Well, I think, first and foremost, that transition we're seeing this week is over that issue of Israel and the situation in Gaza. Biden has been under pressure from his progressive wing to, show a little more daylight with Israel, with Netanyahu, and he really has resisted that. Of course, we saw him last night take that almost victory lap, if you will, after the ceasefire was announced, and sort of expressing hope that both Israelis and Palestinians can live in peace, but also pledging to replenish the Iron Dome. So sort of a signal to progressives that, we're not pulling around 180 degrees here. So, Biden has been trying this whole time to hold together the party. I think with doing a little better than people have expected, but time will tell. But you guys, you need to give Emily a day off one of these days. My gosh, she's working hard for you.
Oh, she's been doing a great job, and of course that's about the white marble up at Congress. Tell us about the mood at the White House. I mean, we're more than 100 days in, and there's a dynamic and there's a schedule. We're all getting used to it. A big difference from the previous administration. What is the mood at your White House?
I mean, they are sort of settling in, as you mentioned. They have a big day today. They've got the meeting with the South Korean president. We think that chip shortage is going to play a big role in it. Biden and President Moon are going to speak at 5 p.m. today, so we'll be watching that closely. This is only the second time he's had an in-person meeting with a foreign leader. But yeah, I mean, they're sort of, settling in for the long haul. Remember, this Biden White House is staffed with people that worked in the Obama White House and in the Clinton White House. Those White Houses lost their House majorities in the midterm elections. There's a sense in Biden that there's no point in, gearing down and doing things slowly. It's like go big or go home is the mantra, and that's what we're going to see from them as they, of course, continue to pitch that American jobs plan, and in particular look at whether that infrastructure part of it might get split off into its own bipartisan deal.
To be clear, Josh, it seems as if that bipartisan part is getting split off, is most likely to get done as probably a $500 to $800 billion plan with bipartisan support. What comes next? How likely is it that there's enough of a consensus among Democrats to get the rest of Biden's agenda through?
I think there's a consensus to get some of it through, maybe not all of it. I mean, Biden has been clear that he wants to try that. So, as you say, split off what can be done on a bipartisan basis, and then push forward the rest with Democrats. There's dispute even among Democrats around even the corporate tax rate. For instance, Joe Manchin, that swing vote senator, he wants 25% or no higher than 25% for the corporate tax rate. Of course, Biden is proposing 28%. So we'll see. I think they wanted progress by Memorial Day. Gee, what does progress mean? We don't really know. It's eye of the beholder.
And especially as a lot of the messages are getting increasingly confused. I'm pointing, for example, at the idea that a number of states have rolled back some of the enhanced unemployment benefits to get more people to drive them into the workforce to actually go work and get paid rather than sit home and deal with whatever they have to do and receive a check. I'm wondering how much this stymies some of the Democratic message that this was sort of a template for what people should be seeing with respect to a safety net? I mean, is there any pushback on that front?
I think so. It's clear that Democrats in Congress don't all want a revolution that some of the party's progressive wing want. We're starting to see that come through. Remember, it's not just one bill; it's two bills that Biden is trying to push through. The third one, the American Families Plan. Sources have told us that is the one they view as the long shot, the least likely of passing, in any form, but certainly in its entirety. So, we're going to sort of watch how that goes. Remember, the backdrop to this was all sort of framed as reaction to the virus. And, we're all moving past it seems, in the U.S., but the numbers really are moving down. We have not had a day with more than 30,000 cases this week in the U.S. That has not happened since the start of the pandemic. It's remarkable. People are losing sight of that, I think.
Josh Wingrove, one more question. Where's the vice president fit in? Well, give us the post-100 days, day-to-day rhythm of the vice president with this administration.
Well, I believe she'll be meeting as well with the South Korean president. So, she's in the room. Biden wants her to be in the room. She got the deal that Biden got from Obama, which is getting to be the last person. Of course, he's given her either the excitement of a file or the burden of a file, depending on your perspective, to manage that border issue. So that one remains on her plate. But yeah, we'll hear from her more today. Of course, she did speak yesterday as well with President Biden when he signed that COVID-19 hate crimes act. That was a big moment for Democrats, and the first time we've seen a full maskless East Room in the Biden White House. It's been months in that. Yeah, so I felt a little nervous watching it, but I assume everyone's vaccinated.
I just spoke to the control room, Josh. Emily's going to have the week off next week in the 6 o'clock hour, which is good news, and you're going to replace her.
Did I paint myself into a corner or
You are
what?
going to replace her, so we'll see you at 6:20 on Monday,
Wake up
Tuesday,
4:10,
and Wednesday.
Wonderful.
And maybe on one day, the early edition of Bloomberg Surveillance might want a word with you too, Josh.
Yeah.
Right.
That's at 5 Eastern time. All right? Hey, Josh,
My
it's great
pleasure.
to catch up. Thank you,
Happy
mate.
to help.
Good
Happy
to
to
see
help.
you. As always, Bloomberg White House correspondent Josh Wingrove there. Your equity market up 1/3% on the S&P. A little bit data out a little bit later, Tom. Can we call this a summer Friday? Are you comfortable with that?
Yeah, I am comfortable with that, but what I really see it as is a recovery Friday. What I noticed on the streets, John, Wednesday and Thursday, is it decidedly different in New York. I think all of our viewers and listeners are feeling that. We certainly hear that from Mr. Paulson out in Minneapolis. But, John, to me, it's almost, it's a summer thing, but to me, it's a recovery thing.
I'm told the weather in London is absolutely brutal, Lisa, and we had hail this week. So I'm not sure they'll be calling this a summer Friday.
No, they won't. You'll be getting hate mail. Nice that you're sitting pretty in New York City while we deal with a hailstorm. Everyone is going out to eat, though. You going out to eat?
Getting a tan. Nice sun. It's hot.
Really?
I'm going out to eat. Of course I'm going out to eat.
Yeah? Do you go out to eat every night to make up for the past
I'm having
14
3
months?
dinners just to wind up Chairman Powell. From New York
Have
City,
fun.
alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Equity markets up 1/3% on the S&P. Yields unchanged at 162.50. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
From New York City on TV and radio, here's the price action. Shaping up as follows on the S&P 500. Advancing 16 points, up 0.4%. On the NASDAQ, up about 0.4. On the Russell, by 0.6%. You want to call this a melt-up?
It's a melt-up.
It's a melt-up.
I'm looking for some excitement.
We can call it a melt-up. My question of the morning, when is the story fully priced? Macy's out early this week with nice numbers, a nice forward look. Stock was negative. Cisco out with numbers, warning about maybe profitability getting hit because of the supply chain story. Stock finished the day positive. Get your head around that for a little bit. Switch up the board. In the bond market, we look like this on 2s, 10s, and 30s. We don't, because I did something else. Here's a chart.
That's nice. I like that, John. On radio, that was the hype point of the week.
That's my fault and not the control room's. Here's a chart of the European Surprise Index, Tom.
John, it's never the control room's fault.
It's always my fault. I know that. I just want to make sure the audience knows that this one really is my fault. The European Surprise Index, put this one up here because it's moving up and to the right in a big way. It's a really, really decent upside surprise again this morning on the PMIs. But we've been waiting for this, haven't we? For Europe to start outperforming. And here it is. The PMIs are great. And this is what the FX market did, which goes back to my question. When is the story fully priced? There was a plan here. Switch up the board and get to the FX market. Euro dollar better be here. There it is. 120,
nailed it.
220.
Like a Swiss watch.
I had a plan. I'm executing it clearly really well.
Really?
Euro dollar negative about 1/10%, even with the better than expected economic data.
I like how you were jawboning at the screen. It better be there. This better be the euro dollar.
I was talking to myself, having a word with myself, Lisa.
His other properties will be smoother this morning.
It's a summer Friday. Give me
We're
a
all
break.
there. You've got a break.
I want to get to the weekend.
It's like 9.
Am I done? Are we done? I need to run away from
Are
this.
you done? You are so done.
I'm pretty sure I'm done.
John Farrell, thank you so much.
I was done about 45 seconds
and
ago.
seriously, folks, for those getting into the weekend, as John mentions, with the Europe doing better, it's the rate of change. It's all happened rather suddenly. Romain Bostic, I believe, is in the house, and maybe he'll be smoother in his report.
I'll try my best. You ask a lot of me here, but we take a look at some of the movers here in pre-market. We're going to start off with Deere here. Of course, this stock having a phenomenal year. This is the best start to the year for Deere in about 3 decades here. The share is already up more than 30% on a year-to-date basis, up another percentage point here in the pre-market. They came out with earnings, but more importantly, that forecast, that guidance that they gave going forward, well above street estimates. And I'm talking about guidance on net income. I'm talking about guidance on a GAAP net income basis here. The company really benefiting from that increase in crop prices, also benefiting really strongly here from a big boost here in the export market. Keep an eye on that. Keep an eye on what's been going on in the EV space as well. It's been kind of a topsy-turvy week. Lordstown Motors took a ride, down 5% here today. Yeah. They were actually down 15% yesterday on a brutal downgrade over at Wolf Research. Not only downgrading the stock, but saying its new price target is now $1. A lot of that is is because of what people are looking at with regards to Ford. Remember, Ford has been very aggressive over the past couple of months in rolling out their EV strategy. Analysts are very bullish on this, and they're saying the real kicker here with Ford is the way that they're pricing Ford F-150, the electric version, and some of these other electric vehicles. They make it very competitive, and it's going to be really hard for some of these also-ran companies to sort of keep up here. Remember, Ford also coming up next week, at the end of next week, has a big investor day where they're supposed to lay out a little bit more clarity on the number of models here. That's going to put a lot of pressure on some of these companies like Lordstown and some of the others that I guess aren't named Tesla. Tesla actually having a good week.
This is all great, but the lead indicator for the Midwest and our cyclical boom is the Detroit Tigers. They're on fire.
Is that it? Are they?
They're on fire.
Okay, I haven't kept up with the Detroit Tigers.
They're on fire. Break up the Tigers.
Break up the Tigers. All right, flip up the board. Here are a couple other things for you, Tom, that you might want to break up here. Facebook, actually now, interesting note out over by Goldman Strategists, saying this is now one of the top picks by hedge funds. About 27% of the hedge funds that they track now own Facebook. Not only that, but they said about 57% of those funds have this as a top 10 holding with regards to weighting. They're actually saying it's Facebook, Amazon, Alphabet, and Microsoft basically have now become the largest holdings here. So they're actually signaling a sort of a rotation back into some of these big cap tech names. They're saying some of the cyclical names still rank pretty high, but a lot of these hedge funds have gravitated back to big tech. Keep an eye on that. Keep an eye on McDonald's. It's unchanged here in the pre-market, but there was an interesting lawsuit that came out last night. Byron Allen, of course, the big media mogul, has sued McDonald's. It's kind of a complicated lawsuit, but it has to do with allegations of racial discrimination over advertising. Of course, Byron Allen owns a ton of media properties, most famously the Weather Channel. I bring it up, too, because Byron Allen's actually going to be a part of the Business Week, a live event later today, so he'll actually be interviewed there. You should register for that for any viewers out there who haven't checked out. And Decker's Outdoors having a phenomenal quarter. Tom, this is the maker of Uggs. I know you're a big fan there. Those shares up 7.5% here in the pre-market.
Romain Bostic, thank you so much. Greatly
Don't let that pass by.
Yeah,
Romain, thank you. Do
He
you wear
just
Uggs?
killed me there.
Do you wear Uggs, TK?
Huh, he does.
Do you wear Crocs too?
No, I buy
When he
Uggs.
drives his tractors
Like
In
Uggs
Uggs.
to his
all
deck.
through the house. Let's do this. We have tried as
Let's
all
do
we
this,
can
yeah.
today to avoid the inflation debate. We decided we should get somebody qualified to talk about the inflation debate. As John and Lisa mentioned, it's front and center across America in economics, finance, investment. Ed Hosseini is out of the Math Economics Combine in Hamilton, New York, Colgate University, with Parchment from Harvard as well. He's with Columbia Threadneedle and joins us this morning. Ed, I love in your note, you speak of inflation dynamics, which is a real mature idea of speaking of the complexities forward. Everybody's talking simplistically about inflation. Tell us the complexity of inflation dynamics as you look to the end of the year.
Yeah, so thanks again. I think you can kind of split inflation into two big stories. One is psychology, the other one is power. The psychology really kind of connects to the expectations component. It's what the Fed is trying to drive over the medium term. Our expectations are a little bit too low versus the Fed's 2% target. The power aspect is the dynamics in the labor market, the dynamics in supply markets right now, where things are just not connecting. We have significant frictions across those markets, and those frictions will take some time to resolve. And I think there's a debate to be had in terms of how long those frictions will take to resolve. But in the background, we have the Fed essentially targeting not inflation at the moment, but the price level. They've put a temporary price level target for us to make up for some of the inflation shortfalls in the past. We're in this weird zone where the Fed's looking really at the price level. The rest of the market is really looking at short-term rates of inflation, and there's a big disconnect there.
Ed, is that just a disconnect between a policymaker that focuses on the destination and a market participant that's looking at the path?
I think it's basically that. I think it's basically that. There is, on the margin, an element of doubt, which is, look, essentially, we have a very poor understanding of how inflation is formed. We've had the comfort of looking at inflation that's been relatively flat, below 2% for the past 25 years.
Okay, traders, I'm going to place order to buy right now British pound. The price I'm looking to buy 142.114. Okay, if you want to trade British pound, here is your chance. So you can place an order to buy at this level. Okay, and stay with me. We will go through this trade together and we will finish this trade, close this trade in profit. Okay, I'll speak to you later as soon as this order will be filled. Stay safe.
The first half of next year. And then if that persists into the second half of next year and sort of the various flavors of inflation expectations remain elevated, I think the Fed will start getting comfortable with the fact that inflation dynamics have shifted. Underneath that is a core question, which is really around wages. I think it's an incomplete story if we look at inflation in isolation without looking at wage growth. And so unless you have nominal wage growth pick up, unless you have it sustained at levels where it can potentially feed back into inflation, the picture is still incomplete. So we have a long way to go.
It's an incomplete picture. One picture that we do have, though, is the degree to which markets broadly, stocks and bonds, are leveraged to Fed policy. The idea here that even a talking about tapering caused an increase in real yields pretty much automatically. Could the Fed really ever raise rates, or is it going to be too disruptive to the economy for them to do so?
That's a really good question. I think, mentally we're all kind of anchored off of the 2013 experience, including the Fed. I think a replay of that experience when rates went up, 100 plus basis points in both nominal and real terms across the curve. We don't want a replay of that experience. That's a very sudden tightening of financial conditions. So the Fed strategy at the moment is really focused on ambiguity. They've given themselves a lot of room to start the discussion, to outline the parameters of that discussion, and then eventually taper. And the idea is, as the market internalizes that, and look, the timeline for the Fed, I think is relatively well chewed through. The market believes that the Fed will essentially start the taper conversation in August or September, announce it towards the end of the year, and then start tapering at the beginning of next year. We've kind of internalized that quite well, and that gives the Fed an advantage in that they can delay. There's absolutely no pressure on the Fed to actually pull the trigger on this discussion in August or September.
Not right now. Ed, thank you, sir. It's good to get your thoughts on the matter. Thank you very much. Ed Al-Husseini there, the Columbia Threadneedle global rate strategist. In the market right now, in the bond market, yields unchanged, Tom. Just south of 163 on 10s on a 30-year at about 234, call it 233, and in the equity market up 0.4% on the S&P to 41.72.
Well, it's a quiet week. You need quiet weeks. Of course, that's where you build up the worries. You're reframed. You have what Louis Giamatti calls distribution, the back and forth, till you get to the news. I look out at the news next week. We've got home sales. I think, John, that's going to be a booming market as well. You move on from there to durable goods, things like that. But more than anything, you're going to get personal consumption and a new look at GDP, a second look at GDP.
We'll take another look at the banks on Wall Street very shortly. We'll be catching up with Mike Mayo, the Wells Fargo head of U.S. large cap bank research. Looking forward to that after the rejig we saw at JP Morgan, which I have to say this Friday feels like it took place a month ago. And Morgan Stanley, the rejig there in the C-suite that took place yesterday. Before we get there, here's the price action shaping up as follows on the S&P 500. Your equity market is elevated, a lift of 17 points. I was waiting for that. Up 0.4% on the S&P. Go to cash. 162.67 on 10s.
One more time. What was that?
Euro dollar 122.40.
Summer Friday.
WTI 62.96. I'll get serious. On TV and radio.
On another property.
That's true. That's true.
Not this one.
That was so close to home. That's so true. Tom Keene, Lisa Abramowitz, Jonathan Ferro. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. President Biden says the U.S. will help Gaza with humanitarian aid in the wake of the 11-day conflict with Israeli forces. The ceasefire brokered by Egypt took effect early today. Israeli warplanes and artillery pounded Gaza, whilst Hamas militants fired rockets at Israel. At least 232 Palestinians were killed. 12 people were killed in Israel. In the UK, the number of cases of a coronavirus variant first identified in India more than doubled for a second week. More than 3,400 cases of the variant have now been detected. Prime Minister Boris Johnson says it could affect...
Okay, traders, long position open on British pound, as you can see at 142, 114. Okay, stay with me, all of you guys who decided to follow my trade and get this pair contract, or if you trade pairs not as on margin as the Forex, as the currency, stay with me and we will go through this trade together. Okay? If you want to get a strategy, please go to company.co.uk. If you want more precise, more specifics about how we trade and what indicators we look and what kind of information we look in when we place trade. Stay safe, guys.
On air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Okay guys, direction change for British pound. In this case, what we're going to do, I'm placing new order to sell short British pound. The price I'm looking to sell, 142, 121. 142, 121, just above our open position, long position. Okay? Okay, I'm placing an order to sell short at even 123 right now. 123. Okay, I'll speak to you later, guys.
Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Key focus is on whether and how a CBDC could improve on an already safe, effective, dynamic, and efficient U.S. domestic payment system. We think it is important that any potential CBDC would serve as a complement to
and not a replacement of cash and current private sector digital forms of the dollar, such as deposits at commercial banks.
That was the chairman of the Federal Reserve, Jay Powell, there on a digital currency in America. From New York City, this is Bloomberg Surveillance alongside Tom Keene and Lisa Abramovich. I'm Jonathan Ferro. Here's the price action, cross-asset. Equity futures up 0.4 of 1%. Is Maltub the drinking word of the day? Equities up 18
orange juice
points
has pulp in it.
on the S&P. Yields unchanged at 162.67. Spiked juice. In the FX market, euro dollar 122.14. We're negative about 1/10 of 1%. Let's sit on the euro just for a moment, Tom. President Lagarde speaking in the last couple of minutes. She's talking about inflation rises due to the temporary nature of things in 2021. Should see through a period of higher inflation. Inflation fundamentals are not there. The recovery remains uncertain.
This is different. We got to stop the show here. What David Wilson has is important. We got to get to it. But John, it's a jumble of headlines. We would not have heard this from Dr. Draghi.
So I want to be very careful with our interpretation. These are headlines that we've taken from her comments, and I think you need to hear her comments from her to get the appropriate context. But there has been some criticism of the ECB president and the communication over several news conferences more recently, Tom, and the lack of clarity around things like the asset purchase program.
Coordinated policies will continue to be needed? That sounds like a surveillance headline.
What, we need some coordinated policies for this show?
We'll discuss that after the show.
John, seriously, when's the ECB meeting? I've lost track of that.
June 10th.
June 10th. Okay, well, we'll get more there. Futures up 17. They advance through the morning. And this is really, really important. David Wilson parachutes in. We never have a clue what he's talking about. And I am in the David Wilson timeout chair because, John, I did a big no-no. I just extrapolated the trend off the 2018 lousy bear market, and we hit S&P 5,000 out at the end of next year. David Wilson here on the earnings drive to get to S&P 5,000. Extrapolation's dangerous.
It always is, but you know where we are now is definitely different than where we've been in the past 40 years.
Something's changed.
Exactly. When you look at yields relative to inflation, real yields, that's the issue. Absolutely.
Now you're promoting Pharaoh's show?
I'm simply stating what the folks at Crescat Capital were pointing out in their latest monthly investor letter. You know, among other things, looking at the earnings yield on the S&P 500. And bear in mind, it's the inverse of the price-earnings ratio. So if you figure, you know, S&P 500 PE of 30 works out to an earnings yield of about 3.3%. That's just about where it is at the moment, touch higher than that, 3.4. Compare that with U.S. consumer prices up 4.2% in the 12 months ended in April. So when you put that all together, you're talking about a yield of minus 0.8%. You have to go all the way back to December 1980 when Paul Volcker was trying to bring down inflation to see a yield that negative.
What does it signal? Can we extrapolate forward and make a guesstimate of what it means?
Well, it's a concern for the folks at Crescat. It's basically telling them that stocks are looking pretty expensive at this point. You know, if you're paying negative yields in essence or getting them, I mean, just bear in mind, bond market's been all about negative yields in much of the world for quite a while, and that's been the concern. So now you're seeing it show up in this sort of different way in stocks.
Dave, this is exactly where I was going to go. It's negative real yields all over the place. Well, I mean, honestly, it raises a question about the amount of liquidity that's been pumped into the system. And as I do on Thursdays at 4:30 p.m., the Federal Reserve releases their balance sheet total. And it's a new record high of $7.9 trillion. There are some proposals out there from Deutsche Bank. I am such a nerd, and I embrace that. You know, there is this expectation that despite taper talk, the balance sheet will continue to expand going forward. Can real earnings yields go even more negative given the incredible amount of liquidity both from the Federal Reserve balance sheet as well as from fiscal spending?
Well, there's always that potential, no question. You know, you look back to the 70s and into the early 80s, and you see yields that are even more negative than we have now. Nonetheless, the idea that this is a change, it really just happened in April, you know, Crescat looking at monthly data, you have to at least ask the question, you know, are stocks looking expensive here? They're certainly asking it.
Is Pharaoh still with us?
I am.
We're not sure.
John, are you still with us?
Yeah, well, you worried you'd lost me.
It's piled on gloom here. I mean, it's the pendulum of Wilsonian gloom.
Are we calling it that?
It's Wilsonian gloom. I mean, Lisa picked right up on it. She was the high point of her day.
that we got gloomy.
Hold on a
You
second.
realise when you were away on Monday, Lisa was bulled up.
Okay, let me just be really clear. It's not that I'm gloomy. It's just that I'm trying to understand what's not priced in, if you will, looking around corners, trying to see around them, John.
Come on, David,
what does that mean if we're in a bull market? It's
What's
that you're
not being
gloomy.
priced in?
And it's constantly things to the downside, seemingly.
Well, not necessarily, because we heard earlier from Greg Draco that there could potentially be an upside surprise
Some
with the amount
upside
of
risk, Lisa.
yes, upside
Some
risk.
upside
I mean, that goes to inflation, and then there's of course the
Of course,
downside risk.
there we go. So the
I can
only
always go
upside
there.
risk that Lisa wants to talk about, TK, is inflation. Upside risk on inflation.
No, in terms of spending. But
Spending,
carry on.
okay,
Yes.
cool.
David Wilson, go away. Listen on Friday. That was
I'm
way
here
too
for
much
it.
math on Friday.
Simple subtraction, Tom. That's all it is.
Simple subtraction. Very good. David Wilson, thank you so much. John, I'm seriously, there's a bid to the market. I know it's not much of a percentage move, 0.5% on 0.4% on the Standard & Poor's 500. But I'm sorry, John, there's a
nudge.
There's a nudge this morning.
President Lagarde out with some more headlines, Tom. The ECB committed to preserving favourable conditions, must provide support well into the recovery. Italy in mind here, with the 10-year yield in Italy back through 1% over the last couple of weeks. And I think that's the focus going into June 10th for the ECB meeting and that news conference with President Lagarde.
Well, yeah, well into the recovery is the thing. I mean, in the ECB's defense, John, they've been a little clearer about extending their timeline out clearly. I think they've done a much better job than the Fed of saying 2022 and even 2023.
The time contingent guidance is sometimes helpful, but it's unhelpful, Tom. It's time contingent forward guidance.
Oh, thank you.
Instead of state contingent forward guidance.
Yeah, that's like another trip to Brandy Melville, but we won't go there.
In the data and say when we get there, we'll do something.
Guidance.
Are we done?
We're so done. Time contingent guidance.
Okay, you know that anyway.
I do?
Yes, you do.
Okay. I'm looking at the bond market, John. Can I say curve flatter? We haven't talked about it in ages, but there's some really serious, interesting fixed income dynamics.
It stopped steepening. I think you can say that. And real yields were the move of the week. Real yields were higher.
Well, it's a show of the week, so, it dovetails on. It's time, folks, to tell you about the real yield, 1 p.m. this afternoon. Seriously, folks, this will be something to get you ready for the weekend with the fixed income market coming out. The publications tonight, I can't wait, just as an example, to see Mike Ferroli publish over at JP Morgan this evening to see that view, because there's a lot of shifting going out there, and it's displayed in nominal yield, less the inflation adjustment, which gets you out to the residual.
They're calling it the residual. Okay. Tom Keene.
That was going to be the name of my new property.
Jonathan Ferro.
The residual.
The residual.
Your equity market up 0.4% on the S&P. We advanced 18 points. Doing my best to keep this on the rails. A couple more hours. In fact, I've got 45 minutes left with you. This is Bloomberg.
closures and the complexities of COVID, it became apparent that if we could provide this course in South Australia, it would benefit trainees of anaesthesia in the state.
As you can see, it moved far away, British pound, from our order to sell short, second order. So for time being, I'm going to cancel this order. So we're still holding long position on British pound at 144.114. Okay, for more information how we trade, please go to companyeye.co.uk and find out what we use, what kind of information we use in order to enter trade. I'll speak to you later, guys.
And more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
all this money sloshing around, these incredibly low interest rates, I think we risk an inflation surge.
If the economy stays as strong as it is, fueled by all of the stimulus that was put behind it, you get inflation.
Economists and everyone, companies are having a really difficult time keeping up with how fast fundamentals are improving.
What we're seeing in the U.S. is just a very rapid rebound in demand, and supply is taking a little bit of time to adjust.
We see a decent amount of risk that inflation could keep rising. It's already rising, but stay higher for longer.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. It is a simulcast on this Friday, set for the weekend with interesting markets as well. Futures up, futures up 18. The VIX 20.37. Some good news there. And then all of the data in this odd week we've seen. John, the inflation debate, it just struggles forward. I thought it was a clumsy debate this week.
You'll see it again at 9:45 Eastern time when we get the PMIs in America, and there'll be a focus on the output and a focus on prices paid as well. But the top line, the headline number, still in the 60s. That's terrific. And it's set to continue, Tom. There's a lot of demand in this economy, and the demand-supply mismatch has been the story, and it continues to be the story, with inflation at the epicenter of that debate.
The epicenter of the debate, as David Wilson just talked about with the S&P ratio and all that, I really didn't understand what he was talking about. I'll let you translate it afterwards. But, John, you know, what I would go to, John, I think is so important, is Greg Dako opening up surveillance this morning and making very clear Oxford's optimistic view. Those are numbers that are not in the market right now.
Well, Lisa brought up a good question, is what happens with the savings rate. And I do think that's important later this year. It's very, very elevated. A lot of money has been accumulated over the last 12 months, money that could have been spent, that was not spent, that will be spent, the degree to which it will be spent and how much will be over the next few months. I think it's important for what these numbers look like.
I do agree. It's the heart of the matter, all the cash that's out there in different guises. But, Lisa, the idea that, I mean, I get that we'll consume it and all that, but to me, the idea that ultra-conservative money is somehow going to move into Apple shares, I just can't get there.
Well, there's a question of the disposable income that people actually have versus what's considered wealth. That was sort of what Greg Dako was talking about. To your point about Dave Wilson's chart, I think there is an important point here that, frankly, to me was one of the biggest takeaways of the week, which is pricing power. Which companies have the ability to raise prices, pass along the increase in input costs to their consumers, and which don't and are seeing deeper negative real yields as they pay higher prices. And to me, that seems like an increasing distinction within markets, Tom.
Yeah, John, what we're long in London is shovels. Hail in May, John, would you explain the weather in London?
The weather has been absolutely abysmal in London, just as the UK's reopening. More rain, I think, over the next week as well. I've been exchanging a photo of the weather app on my Apple iPhone with my family, Tom, just taking a snapshot of what the week ahead looks like in New York and what it looks like in London, and it's not pretty.
Yeah, Mike Bell coming up here with a bonkers hailstorm. We'll talk about that in a moment. John, let's walk through the data here right now before we get into good conversation. John, I'm going to look at a sustained equity lift, not a big percentage move, but off of the melt up 2 days ago and then the good action yesterday. It continues this morning. Futures up 18.
Up 0.4% on the S&P and taking a small bite out of a weekly loss so far on the S&P 500. More broadly in the bond market, looking at yields not doing much this morning at 162.33, basically where they started the week. And I will say also the average since the start of April is basically where we are too on a US 10-year at 162. It's what's happening beneath the surface of the nominal yield that you need to pay attention to, Tom. Real yields coming in this week, coming in. And I know we're still negative about 80 basis points, but it's worth a look.
Yeah, well, right now, let's bring in Mike Bell in London with JP Morgan Asset Management. And, of course, the hailstorm is one of the media there said it was a bonkers hailstorm. Mike Bell, give us the hailstorm, the uncertainty, if you will, of emerging markets. They have not been something we focused on. They have been removed. Is emerging markets, as a broad sense, an opportunity forward or not?
I think it's probably actually the biggest opportunity over the next decade that we see. I mean, we think that China, for example, is going to grow at about 4.5% per annum annualized over the next decade, which means its economy is going to be about 50% larger in 10 years' time than it is today. So to put that into some perspective, you're talking about ballpark a $7 trillion increase in annual consumption by 2030, which is larger than the UK and German economies combined. And then you've got India. It's going to grow faster, but from a lower base. We think it'll grow at nearly 7% a year over the next decade, which means the economy should roughly double in that period. Obviously, there's a lot of difficulty going on in India with COVID at the moment, but we think that by the end of the year, they will have vaccinated around 60% of the population. So we're bullish.
And John, this is like a foreign conversation to us. We've been so focused on transatlantic and the pandemic and all that, we forgot to reset on Asia economic growth.
Rebecca Patterson of Bridgewater mentioned that a bit earlier. And Mike, the uncorrelated asset of the year for some people has been the Chinese bond market. Is that something you're looking at too?
Yeah, we think that's attractive. Obviously, there's a limit to how much people outside of Asia are realistically going to put into Chinese bonds. But nevertheless, I do think that when you look around the world, it's one of the few bond markets that really offers an attractive yield at the moment. So it's certainly something that can be used for diversification purposes.
Mike, there's China and there's India and then there's everyone else in the emerging markets. And I do wonder about some of these studies that are coming out of the World Bank and other organizations talking about the great divergence, the fact that the recessions have been brutal and are affecting the middle classes in a lot of these nations way more than, for example, the U.S., the Eurozone, and China. How do you parse out this distinction within the emerging markets between the haves and the have-nots and the maybe have-nots for an even longer time post-pandemic?
Yeah, I think that's important. I mean, our preference at the moment is for Asia. If you think about MSCI EM, China, India, Korea, and Taiwan are about 75% of the index. So we're pretty favorable on the outlook for those four countries. But in some of the other parts of the emerging world, where, as you say, it's going to take them longer to get the vaccine fully rolled out, we've got higher concerns.
You know, Mike Bell, I look at this. I was talking to Brad from Brisbane this morning, somebody who watches the show every day. And Mike Bell, to me, it's a lot of micro stories, and it can be on the vaccine and the serious nature of it, the distribution of the vaccine in Indonesia, what the World Bank's going to do, what the IMF is going to do, and all that. And then there's, on the complete other end of it, people saying we're going to deploy. JP Morgan is going to deploy into Hong Kong. If you want to give us news on that, we're taking notes. But I look at like Hermes opening in Brisbane, Australia, or reimagining it, whatever that means. I mean, that's a huge deal. All these micro stories from Australia on up to Japan.
Yeah, ultimately, I think like businesses are going to take the long-term view. And the long-term story is that rising incomes in Asia is going to be the key source of growth over the next 10, 20 years. So I think that's why you're seeing lots of businesses pivoting towards Asia, and I don't think that's going away anytime soon.
Mike, where's the European trade fit into all of this? A lot of people getting long Europe recently on the idea the data improves, but the price action's been there. It's been positive in European equities all year.
Yeah, I mean, Europe's benefiting, obviously, from the fact that you're getting this booming global goods trade, which Europe benefits from. The domestic economy is obviously lagging because they've been a bit slower to roll out the vaccine. But nevertheless, if you look at the daily pace of vaccinations in Europe now, it's actually caught up to the UK. So I think you're going to see in the third quarter pick up in the domestic economy as well. So I think European equities will move higher. Whether they outperform something like the US, I personally have a preference for, say, US financials to European financials, but I still think that European equities will go higher.
What about the other large caps within the United States? Are you seeing opportunities there, or do you think that most of the gains there have been had?
Yeah, ultimately, I think if you look at S&P 500, for example, 12-month forward earnings in 18 months' time should be about 15% higher than where they are now. So the question is, to what extent do valuations come down to offset that? For the most expensive stocks, it's possible that they come down and offset that. But we're seeing plenty of reasonably valued companies in the US where we think you can see returns in the region of, as I say, 10 to 15% over the next 18 months without too much difficulty. Now, as bond yields go higher, we think we're going to see 10-year yields head up to around 2%. That tends to favor things like the financials and may weigh on the valuations of some of the larger tech stocks. So we've got a value bias within the US.
Mike, got to leave it there. Mike Bell, JP Morgan, Asset Management Global Market Strategist over in Europe, in London. The weather, terrible. TK, where did Brisbane stuff come from? What's that about?
To me, it's a micro strategy. I mean, I think, John, this is so important. You got guys like Mike Bell, which are at 60,000 feet and all that. You know, and you got the low end, the high end, the middle. I learned this years ago. There was a point, John, years ago where EM was owned concrete stocks and telephone stocks. That was the whole strategy. And some really brave people, including Mark Mobius, changed that view to going to micro stories that are there. It just happens Brisbane and Hermes was there, but it could have been something else in Vietnam.
Well, the index, the MSCI index, is now heavily weighted towards tech and Asian tech for emerging markets. TK, you ever been to Brisbane?
No, I'm supposed to go like 4 times. It's really, John, this is true. You're in Singapore and you go, okay, we want you to go to Sydney and meet some people. And then they go, it's just so far to get there and then to get back to New York. I've never been.
You should just go up to Brisbane, South Bank. There's this fake beach. I think it was called Streets Beach or something like that. Your kind of vibe, Tom?
I don't know. The Veronicas wanted me to come down there, but I just couldn't get there.
You'd have a great time.
Yeah.
Then go to the Gold Coast. Go to the beaches.
I'm trying to see around corners of this show. I can't. What's going on?
It's Friday, Lisa. It's Friday, Lisa.
You're doing what? Trip planning?
I lived there for a little bit.
You did?
Yeah.
Where haven't you lived? Seriously. You've done a tour of the United States?
Had a nice time in Brisbane.
What were you doing there?
Years back. Just looking around at the Aussie dollar, thinking about the future, looking around corners.
Good. I'm glad that you had some time looking around corners.
Coming up, Mike Mayo, Wells Fargo head of US large cap bank research from New York City this morning. Your price action looks like this. Can you play the music, guys? Just play it early. Equities up 16 on the S&P, up 0.4%. In your bond market, unchanged. Yields 162.50. Euro dollar 121.82.
Yeah.
We roll over here, TK.
John,
the euro weaker down 4 cents.
John, this is important. Mohammed in Cambridge says the hail in Cambridge collides.
Collides. The weather's been terrible in Cambridge too. Hello, Mohammed. I'll catch up with Mohammed in about 45 minutes. If you want to tune into Bloomberg The Open.
Oh, good. I'll tune into that.
TV
well done.
At 9 a.m.
I get no love from Mohammed.
Eastern time. We caught up with Mohammed. We talked to him last week.
Did we?
Yes, together.
It becomes a blur.
This is Bloomberg.
With the First World News, I'm Rishka Gupta. Palestinians poured into the streets of the Gaza Strip early today to celebrate a ceasefire with Israel. The Hamas militant group and Israeli forces are now observing a truce that ended 11 days of conflict. At least 232 people were killed by Israeli airstrikes and artillery fire on Gaza. A dozen died during Hamas rocket attacks on Israel. The U.S. is now calling for a global minimum corporate tax of at least 15%. That's less than the 21% rate it has proposed for the overseas earnings of U.S. businesses. Some nations had called that rate, well, excessive. International negotiators are trying to come up with an agreement this summer. The European Union is offering the region's battered tourist industry a chance to salvage the summer. EU negotiators have agreed on the introduction of certificates that will allow quarantine-free travel within the bloc. The coronavirus documents will offer proof their holders have been vaccinated, have recovered from the illness, or have a recent negative test. And the largest maker of agricultural machinery, Deere, has lifted its profits forecast for the full year. Surging crop prices have boosted consumer demand for new equipment. So has the broader upswing in commodities. Deere posted stronger than expected quarterly earnings. And one of the largest insurance companies in the U.S. paid $40 million in March to hackers after a ransomware attack. Bloomberg learned that CNA Financial paid up about 2 weeks after a company trove of data was stolen. That payment was bigger than previously disclosed ransoms. CNN says the company followed the law. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between governments and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
You're going to acquire the technology and install it. I think that's the answer. There are plenty of neobanks and purely fintech banks that will be successful. But I think the fight is going to be on just getting the technology in place, particularly for the larger banks, so that they can compete. So I guess what I'm telling you is I think the basic banking sector will live another day.
Robert Albertson there, the Piper Sandler Chief Financial Strategist from New York City this morning. Good morning, alongside Tom Keene, Lisa Bramwitz. I'm Jonathan Ferro. Counting it down to the opening bell, 1 hour and about 12 minutes away. Equities shaping up as follows on the S&P. Positive 16 points. We advance about 0.4%. A lift here and a move in the euro. Euro dollar negative, just a little bit more so in the last hour, down by a third of 1%.
Did Lagarde do that?
Stronger dollar. Don't know, Tom. Was a gap lower, though. 121.91. In the bond market, 162.50. Yields unchanged and crude positive by about 1.9%. We add $1 and about 20 cents to WTI, 63.11 cents.
One of our high points of the day to get you recalibrated on global Wall Street and particularly American Wall Street. He is, after saying 200,000 jobs will be jettisoned, truly an exile on Wall Street. Michael Mayo joins us with Wells Fargo. From his decades of work, including a dark day with Credit Suisse years ago, to now holding court at Wells Fargo, head of U.S. large cap bank research. Mike Mayo with us. Mike, I've got to rip up the script. This is all anybody's talking about, and you are the one to give perspective. Can a duo run consumer banking? They're going to try that at J.P. Morgan. Is it feasible?
I'm never a fan of dual heads. Having said that, J.P. Morgan cultivates a culture of collaboration. So whoever collaborates better is ironically the one who could ultimately win. We have two women who are in contention to take Jamie Dimon's job. Having said that, you know when Jamie Dimon retires? N+5. Add 5 years to whenever you ask him the question. So I don't think it's happening anytime soon. I think that the board wants him to stay, investors want him to stay, but you do have two women who are in contention.
If the two women are in contention, two men in contention, you know, let's be honest, this is absolutely original stuff. To your research note, which stopped Wall Street a few days ago, how will the dominant J.P. Morgan consumer franchise and adapt and adjust to automation, to digital banking, and the rest that you highlight?
Well, J.P. Morgan is a microcosm of the broader industry. And for you, Tom, I'm going to the classics. I'm going to the Greek philosopher Plato, who said, necessity is the mother of invention. Banks have no choice but to get more efficient, to use automation, and to streamline. So whether it's J.P. Morgan or any other bank, even though they're opening up branches and hiring advisors and all sorts of people, over the next 10 years, we expect headcount to decline by 200,000 jobs, up to 200,000 jobs for the banking industry. And that's because you have automation in the back office, digitization in the front office, and because banks have no choice as they compete against big tech, big retail, and a bunch of non-banks that have a lot less regulation.
How's that going to go down politically, Mike?
Not always well, but it can be better than in the past, because with natural attrition, banks can try to, walk that fine line between becoming a lot more efficient and without destroying their, political and regulatory reputations, and also their ESG scores, because everyone's watching, if you fire a lot of people, that hurts your ESG scores. So it's a tough job. It's a different job to be a bank CEO today. In the past, it was about creating, generating sustained long-term value. Today, it's doing that and a lot more. You need to be more attuned to issues around climate and social issues and diversity. And so it's a bigger challenge.
Mike, what does that mean for the physical presence on Main Street?
Well, a lot less branches. You're going to see a lot less branches and a lot less people per branch. And they call it DIY, do it yourself, and also more do it together services. So you'll see banks, working with customers to show them how to adapt to using more digital tools. And the pandemic turbocharged the tech revolution at banks. You can't force a change in customer behavior, but but the pandemic did so, and that played into the banking industry's strategic playbook for the next 5 to 10 years.
Mike, when you talk about competition from a number of different sources, we should also talk about competition from the Federal Reserve itself or from the U.S. government. The Federal Reserve saying yesterday that they're going to put out a report on the U.S. digital dollar debate this summer that could disintermediate the big banks. How much are you paying attention to this?
Well, you have to pay attention to this. I mean, there's threats to banks, and disintermediation of banking goes back, half a century. And so you first saw that with traditional bank loans getting disintermediated to the capital markets. And then you've seen that with some of the fintech players and the payments business. And so you have to watch, anything related to, digital currencies or anything else. Having said that, I think the banking industry's business model resiliency for the largest banks is underappreciated. And a deposit at a large bank is different than a deposit at another bank. It's driven by a hybrid distribution system that's physical and digital. It's driven by multi-products, whether it's a checking account, savings account, credit card, mortgage, investment. So, yes, you have to watch this, but the death of banks has been greatly exaggerated the last few decades.
Mike, perhaps the death of banks, but just quickly here, I'm wondering what you think in terms of mergers and acquisitions. How consolidated could the industry get as they cut what you estimate to be 200,000 jobs?
Absolutely, there should be an acceleration in bank mergers. Goliath is winning. The largest banks have scale. The smaller banks need to generate that scale. That was mentioned as the number one reason for the biggest recent merger in the last few years, now known as Truist. So we wouldn't be surprised to see half the number of banks out there, over the next decade. More mergers to come.
Just before we run, Mike, a lot has been made of ESG and diversity, and you touched on that yourself in this conversation. You were the one to bring it up. Why do you think that wasn't a big part of the consideration for Morgan Stanley's shake-up?
Look, ultimately, the ability of managers to generate the returns, help the firm as a whole, and represent the firm, drives these decisions. And so, Jamie Dimon didn't select the two women co-heads of consumer who are likely the next, one of those or the next successor because they're women. It's because they're the most capable. So I think the chips fall where they will.
Well said. Mike, thank you. Mike Mayo, Wells Fargo head of U.S. large cap bank research on a situation on Wall Street and a management rejig that we've seen so far this week. From New York City this morning, good morning. Alongside Tom Keene, Lisa Bravitz, I'm Jonathan Ferro. In your equity market, shaping up as follows. 4170 on the S&P. We advanced 16 points, up 0.4%. Some PMI data coming in about 1 hour and 20 minutes stateside. Before we get there, more still to come. We'll be catching up with Terry Haynes, Pangea policy founder, on a situation down in Washington, D.C. It's gone a bit quiet on the infrastructure front. We're up 0.4% on radio, on TV. This is Bloomberg Surveillance.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Minutes from the opening bell in New York City. Good morning to you. Alongside Tom Keene, Lisa Bramvitz, I'm Jonathan Ferro. Your equity market shaping up as follows: up 16. We advance by 0.4% on the S&P. Your bond market just south of 162 on 10. Some headlines crossed on the Bloomberg. The IMF backing a $50 billion plan to help the world escape the COVID crisis and narrow the gap in access to life-saving vaccines that's threatening the global economic recovery from the pandemic. So, Tom, that's the effort right now, calling for a $50 billion spending plan to narrow that gap. The IMF out with that story this morning.
Part of that is the word proposal, and it is a proposal, and they've got to line up the developed nations. There's some really serious action in there about the percent vaccinated in the United Kingdom and the U.S. Call it all in 50%, 50. And John, in Africa, they published 2%. Is the percent of vaccination. That's, to me, the lead quote. But, John, this is a proposal, and they've got to line up America.
To fund an ambitious effort to immunize at least 40% of the global population by the end of this year, and at least 60% or more by the first half of 2022.
The IMF has been talking about this great divergence, the idea that a number of emerging markets have really lagged behind, and you actually see the middle class shrinking. And just to quote the Deputy Secretary General of the United Nations, this has become the inequality virus the diverging world we're hurtling towards is a catastrophe. Can you get the developed world that is rebounding rapidly to get on board and to help pay for some of these initiatives? That's unclear.
Yeah, agreed. Just to recap then, the IMF calling for a $50 billion spending plan to protect the rest of the world against COVID-19 and narrow the gap in access to life-saving vaccines. Tom, that headline just crossing.
No, the headline just crossing, and it does fold into what we see in Washington in the markets. John, help me here quickly on the data. I think it is important on a Friday. I see a persistent lift in equities, even though it's not that big a move.
Yeah, up 0.4% on the S&P. Dollar coming back just a little bit stronger. And I should point out, a little bit later, we'll catch up with the IMF Managing Director, Christina Georgieva, a little bit later today, Tom.
Terry Haynes joins us now with Pangea Policy, their founder here, and a good student of the dynamics of Washington. Terry, there's isolationism in America. It's always been there, back to the founders, a certain character, let's say, in the pre-World War II era, all sorts of shades after World War II, a unique Trump isolationism, a sense there, and now with Israel, Gaza, and even with this announcement from the IMF for a cash call, a new isolationism in Washington. What does that look like?
Tom, good morning. What I think it looks like is essentially a rebalancing of international responsibilities with domestic responsibilities. I think there's a sense, and there's been a sense for about 5 or 6 years that, frankly, I think predates Trump, that we've been spending too much time and effort thinking globalism is going to solve all our problems, and instead understanding that it's exacerbated a lot. What I'll shorthand as the flyover country problem, and flyover nation problem, and we ought to be spending some more time with that. So, we're back to the old wrangle of exactly how much time and effort we ought to be spending on domestic priorities as opposed to worrying about the international. And, frankly, that complicates policymaking across the board.
Do you ascribe to the tradition that foreign policy doesn't matter when people waltz into the 2022 or 2024 booth, or does it matter this time around?
I think it matters to them always, frankly. There are always issues that differentiate candidates, and we see a lot of those happening right now. You've already hit on it with part of it with Middle East policy. China policy, of course, is a very big and frankly bipartisan initiative at this point. But anybody that wanted to change China policy at this point would be looked at very skeptically. The eyeballs on Russia, same thing. Just to name 3 off the top. But yeah, it does matter to voters.
Terry, let's jump to June. The president's first big overseas trip, and he's going over to Europe. What do you think the priorities are?
The priorities for them are they want to show, firstly, they want to show off that their America is back theme, that they want to show cozy relationships across the board with the European Union, number one. Number two, they actually want to show how they're moving the ball forward, and they're going to have to get past this Nord Stream problem and put it into a broader context to show how that decision to waive sanctions there is positive for other aspects of the European project. And third, they want to show a united front against Russia, but more importantly, China. That's where they go.
They've got a Germany problem, haven't they? With that in mind, Terry. Not so much as a pan-European problem, it's a Germany problem.
Yeah, exactly. You know, some wags in Brussels always say if Hitler had understood that all he had to do was to conquer everybody economically, as Germany has with the EU, we wouldn't have had the Second World War. But the more important part of this is that you've got a new government. You've got more instability in Germany for the first time in a long time. You've got a new government, a new way of looking at things. Some people say a loss of confidence. So those are all variables that the administration is going to have to work with to resolve. So it's a higher mountain than it was just a few months ago.
Meanwhile, here at home, Terry, one reason why I love reading your reports is because you actually assign probabilities to the likelihood of certain legislative initiatives getting passed. Where are we in terms of the probability of a bipartisan infrastructure bill getting passed in the near term?
Well, thank you, Lisa. And I've been non-consensus, about 60–65% for some time on that. I think that's coming together in a kind of 800 billion to 1 trillion range at the top. There's clearly a desire to want to do something there, and on a bipartisan basis. It amounts to a plus-up of about 100% over what we would be spending on infrastructure anyway, so it's not insignificant, but it would take quite a while to roll out. The bigger question is whether or not it's going to be able to roll out faster. It doesn't sound like that's going to happen, so people won't see and businesses won't see a difference to that very much. And I also think it makes what the administration calls the families package, which is most of the rest of us call everything else, that much harder to get. Democrats will understand that the last train is going to leave the station. They'll want everything they want in it. People tend to forget that the Affordable Care Act got passed on reconciliation, but it took something like 5 months after the House had first passed it to finalize it, and that's a positive case. So, Washington's going to fool around with the families package into the winter, and probably, I'd say at least into the winter.
What's the likelihood of that getting passed?
I have that at very much below 50% at this point. I'll give you 30%. It's alive and kicking, but I don't see the path forward for it right now.
Jerry, we had the privilege of speaking to the Republican from Montana yesterday, Steve Daines, and it was a really good conversation. I am fascinated by how you translate the middle ground of American politics is personified by Jon Tester and Steve Daines in Montana. What's the future of the middle in America if Montana's living it?
You know what? Those are two very smart members. I've had the pleasure to spend a fair amount of time with Senator Tester over the years, and he's a very capable senator. And somebody that's really looking out for things. The way people present themselves these days is market themselves in politics is polarized. They'd say necessarily so, but there's an awful lot of people trying to figure out what the middle ground is and work on it from there. We're losing some of those good people like Rob Portman and Pat Toomey, but as you point out, people like Tester and Daines are still there, and between him, people like Tim Scott, for example, I think there's still an awful lot of people in the Congress, particularly in the Senate, that are looking to try to figure out exactly how to deal with what we'll call the problems of the middle and improve things. So, I remain optimistic about that in the long term.
Terry, good to hear from you, as always. Terry Haynes there, Pangea Policy Founder, on the latest down in D.C. and on the divide in this country, politically and the lonely centre ground, Tom Keene, that you just touched on?
Well, it's a lonely and retiring center ground as you hear about Ohio and Pennsylvania leadership deciding to exit. We always get that, John, but you really wonder what the retirement path is going to be and the opportunities from retirement, that incentive as well as we get to 2022 and particularly on to 24. John, in the markets right now, I'm looking at a 10-year yield. I mean, the yield is crushed.
Down a basis point. I mean, relatively speaking, is that how boring the price action's been this morning?
No, but, within the tight range we're in, we've come down to a higher price and a lower yield, 1 to 4 digits. Should we go to 6 digits? Let's do it. 1.616592.
Thank you, Tom. 161.65 on tens. Your equity market up 16. We advanced 0.4% on the S&P.
Help me.
I'm helping you. Yeah. Coming up on the program, on the open, Bloomberg opinion columnist and Queen's College president Mohammed Al-Arian, and then with him, Bob Michael of JP Morgan Asset Management on the week that was and the year ahead as well on this bond market, with real yields coming back just a little bit. And both of these guys, both Bob and Mohammed, making the point that maybe you need to taper sooner rather than later. That debate gearing up just a little bit more.
Yeah, it's bond talk.
Well, honestly, though, this is actually really a good question. Can they taper? And what does tapering mean if they then start expanding their balance sheet? I mean, I was looking at Deutsche Bank's Jim Reed's note yesterday, and he basically said if the balance sheet debt ratio stays at the post-Great Financial Crisis level, it'll be at $40 trillion by 2050, John.
Tapering isn't tightening. Remember that. Do you remember that?
Yeah, I mean,
but 10 years ago, whatever it was, tapering's not tightening.
My point being, they might tighten or taper for 2 months, but what does that actually mean in the scheme of things? How much can they remove some of the accommodation?
Enough gloom. Can I just suggest?
That gloom? How is that
gloom? With London, hail, the miserable weather, Al-Arian's living over there. John, it's a gorgeous weekend in New York City.
It is.
Okay, it's just time for a Tang mimosa.
Well, this evening it's going to be. Yes, someone wrote in. It's Friday. Can we get TK on a John Deere tractor with a Tang Mimosa coming down Fifth Avenue?
Not the John Deere tractor.
We could work on that.
Bow tie mandatory.
Got the orange juice with a pulp.
Overall's optional.
With that pill.
Not sure who this person is.
But I think we should go there.
So I'm going to run, guys. This was fun.
Oh, please, as fast as you can.
British sarcasm at its best.
Had a great week with you both. Looking forward to next week too for more of the same. Equities 41.69.
Let me know what happens to Harry Kane.
500. We'll talk. Equities up 15 points to the S&P. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. President Biden says the U.S. will help Gaza with humanitarian aid in the wake of that 11-day conflict with Israeli forces. The ceasefire brokered by Egypt took effect early today. Israeli warplanes and artillery pounded Gaza, while Hamas militants fired rockets at Israel. At least 232 Palestinians were killed and 12 people were killed in Israel. Negotiations over President Biden's $2.2 trillion infrastructure package are nearing a crucial stage. A White House team resumes talks with Senate Republicans today. One Republican tells the Associated Press that they have increased their offer and are working in good faith. The White House had set a soft Memorial Day deadline to decide whether a deal with the Republicans is possible. And Tesla CEO Elon Musk may have set his sights on Russia. In a virtual conference today, Musk said Russia is amongst the countries where the electric car maker potentially could build a factory. He also said there should be more dialogue between Russia and the US. And in Italy, UniCredit has shocked investors by deciding to skip a coupon payment next month on $3.6 billion of bonds. The bank reported a net loss for last year. That's one of the conditions under which it can miss obligations on the bonds. And Apple put its star witness on the stand today in that antitrust trial with Epic Games. CEO Tim Cook is scheduled to be the last person to testify in the courtroom in Oakland, California. He's expected to argue that Apple's rule for its App Store ensure a seamless user experience. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Expect clear, concise conversation on Bloomberg Surveillance.
There's no vowels in a digital future.
Come on, John, I just think it works.
It works. For Brutus.
We've beaten this to death.
Watch weekday mornings on Bloomberg Television.
You certainly see everything here just booming again. Traffic, is just something that we haven't seen for a while here that you're dealing with again as people are actually going down to work. The downtown is coming back to life. So I think companies are starting to reevaluate. The thing that we did here is we went from a depressionary bust to a wartime boom.
Jim Paulson there with Luthold Group, very optimistic on the economy, speaking of the span of the United States of America. Right now, Lisa Abramowitz and I welcome you to, without question, your most important conversation of the day, because it's what we all do as we break bread before the pandemic, in this pandemic, and coming out of the pandemic. There is flat out no one in the restaurant and food business who is committed to optimism more than Daniel Boulud. He joins us this morning with an 11,000-foot triumph at Grand Central Station and the new Vanderbilt Tower. Daniel, thank you so much for joining us on Le Pavillon and the success. This is huge, huge optimism. How urgent is it for you to fill every seat starting yesterday?
Well, thank you, Tom, for having me, and good morning. Of course, it's huge to open a new restaurant, always, for anyone. But it is huge in this time because we really feel that we are coming out of the pandemic and it's time to bring the city back together. And I think for me, it's not about how many seats can we fill and all that, but just bring back jobs, bring back hope, and have the opportunity to create something new and unique. And One Vanderbilt, the project, finished on time, finished on budget. Throughout the year, the pandemic, we had slowed down, but we never stopped. And I think that's something which I'm very proud of, to be associated with SL Green and the project there, because the project kept on going.
When you came to New York, you couldn't get into the fancy restaurants. You were a piddling chef and nobody wanted to talk to you, anything like that. I know now you pick up the phone and you get My Table instantly. What I want to know is, will we change how we eat after this horrific pandemic? Whether the fancy or the less fancy, do you sense that will change the way we approach food?
I don't think so. I think people want to go back to indulge. People want to go back to be pampered, to be to discover new restaurants, to be able to enjoy the food to the fullest. And of course, we are very conscious, and we have to keep our safety as a priority for us, the staff. We keep wearing masks. We try to not make maybe so many dishes who can be shareable, and we try to really respect also distance and timings and all that, so guests feel comfortable. But people are anxious to go out, and I see in my restaurant at Daniel or Barbulu also, the terrace is so much in demand now. It's fantastic.
Yeah, Chef Boulud, whenever you walk down the street in New York City, you see all of the restaurants absolutely flooded with people looking to get back. There is a question, though, and you are not seeing that in Midtown. In Midtown, it still is a bit of a ghost town as offices still try to bring some workers back and have a questionable time frame. What does the power lunch of the post-pandemic era look like?
Well, right now it looks like nothing because there's not that many restaurants open for power lunch. But I think there's definitely a buzz in Midtown, and I see around Grand Central, I see people coming back to the office, and we have people coming out of work and coming to have a drink at the bar at Le Pavillon. But so that means they must have been working around there. And I think power lunch will come back in September, resume when all the hotels are open, New York is back, and I think the office will bring back people because they have to.
Well, when you talk, Chef Boulud, about the cities that are going to be the culinary leaders going forward, what do you hear from your peers, from your fellow chefs, in terms of which cities are the best ones to open a higher-end restaurant?
Well, I think New York City is still the #1 city for sure. I mean, of course, you can always be a big fish in a small pond, but in New York City, I think we have the capability for welcoming tourists and business and entertainment and sports than no other city can. And of course, there's the hype of Miami, there's the hype, but when it comes to fine dining and when it comes to all dining, I think New York City, including all neighborhood, it's amazing. And, people are craving to come back to New York City. I see the double-deck bus passing by the pavilion, because it's on the second floor, I see the double-deck bus full of people. And I'm like, wow, is there some tourists back? And I hear that concierge are calling us and telling us their hotel are reopening. So it's a good sign. I mean, just a question for all the office building to be able to bring back their staff, and certainly the unemployment to resume so we can bring people back to work.
The romance, Danielle, of being at Grand Central Station and looking out that window to the Chrysler Building, it speaks back to Le Pavillon of 1941, 1942 as well. Boy, have we changed how we eat now. What's your biggest challenge in developing repeat customers? What is the food angle, the menu angle that you need to do in 2021 to keep them coming in?
Interestingly enough, yes, vegetable is the rage. But 24 years ago, when I opened Café Boulud in New York, I had already a vegetarian menu. And so this, I expanded more. And so Le Pavillon, the menu will be 50% seafood, 40% vegetable, and 10% of selected high-quality meat. And so there is definitely a trend between, I wanted to have a certain focus on the locality, so the seafood is from New England for the most part, and also vegetable within the 5 state around New York. And I think this will be our focus there. But in general, people are craving for good food, good wine, and of course, healthy food. That's our responsibility.
a colossal financial risk. Really, really interesting. Daniel Boulud, congratulations on launching Le Pavillon, and just really, really interesting to see in the coming months as New York City comes back. Thank you so much. Daniel Boulud, the acclaimed restaurateur. We make jokes about it, Lisa, but the courage here, whether it's Daniel Boulud or it's somebody opening one of the many empty restaurants you and I see on the Upper West Side and really throughout all of the city, there's just a certain courage to get it going.
Yeah, you're seeing that courage implemented in a variety of places. Can I just say, Chef Boulud's children have it better than mine. They had smoothies and poached eggs for breakfast. I was thinking, it must be nice to have Chef Boulud's.
Do you think he's ever taken an Eggo out of the refrigerator?
I actually asked him, and he said no, but he said perhaps Belgian frozen waffles, which I've never heard of. No, they eat better. I will say, the key to success, vegetables, seafood.
Oh.
Not
Tang mimosas.
Tang mimosas.
Yeah,
I'm just saying.
Okay, you're just saying. It has been an eventful day. We're going to try to get to an eventful week. Listen to us on Bloomberg Radio and Bloomberg Television. We do this with a better tape. Green on the screen. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Everything everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
City for our audience worldwide. Good morning, good morning. The countdown to the open starts right now with equity futures up by about 1/3% on the S&P 500. We begin with the big issue, wrapping up a volatile week.
Volatility. The recent volatility. An eye-popping amount of volatility. Equity market volatility has remained elevated.
It's going to be more short-term. What investors are dealing with is this trifecta. The market is adjusting to the moves that we're seeing. An upcoming peak in earnings growth, higher than expected inflation, and premium market multiples.
A lot out there, a lot of moving pieces.
Seeing some pause, some consolidation in certain assets.
Especially with the movement in commodities.
The crypto volatility.
That volatility in Bitcoin. Some of the froth in the market may be pulled out.
Volatility needs to come down.
We need to get through a couple of these hurdles before we can settle down.
What we're trying to do is get rid of some of the volatility that can come with changes in economic environments.
Joining us now is Mohammed Al-Arian of Bloomberg Opinion and Queen's College President, and of course JP Morgan's Bob Michael joins us now too. Mohammed, Bob, great to have you with us. Both of you are making a similar argument around the taper program over at the Federal Reserve that's yet to be initiated. Mohammed, you wrote earlier this week, it's clear worries are growing about the risk of a policy mistake. After all, one of the last things the economy and markets needs is a late Fed that is forced to slam on the brakes. Can you build on that for us, Mohammed?
Yes, John, for a long time, the Fed has been the market's best friend, providing ample and predictable liquidity. And there was seemingly no cost to that because there was no inflation and there wasn't that much evidence of excessive risk-taking. We now entered a different world where genuine inflation concerns are mounting and also genuine concern about financial stability are mounting. And here, the market is starting to sense that the policy risk factor has gone from being a positive risk factor to possibly being negative. Now, it's not going to move aggressively until it has clarity on this or until we hear something more definitive from the Fed. But you really get a sense that the market is now worried that the policy risk factor may not be as positive for asset prices.
Where do you get that sense from the market right now, Mohammed? Where are you looking?
So for the last 2 weeks, we've played exactly the same thing. In the beginning of the week, there is some concern about inflation that emerges, either from the private sector or the public sector. And then people say, well, you know what? It may be an issue, but it's down the road. And then you get people buying on the dips. We've seen it last week. We've seen it again this week. But the evidence is multiplying. And let me remind you, John, something that you know. Macro people are not good at turning points. And they're really not good when they have to read micro information. So if you look at output cap analysis, you're not worried that much about inflation because it doesn't take into account the changes, the structural changes on the supply side. If you're at the company level, you hear it from company after company, and you're seeing companies move to raise wages and to raise prices. So that's the disconnect between the macro and the micro, and it's not a new disconnect, and it happens at inflection points.
But Michael, your words, my biggest concern is that the Fed waits too long to start the normalization process. Do you share the concerns of Mohammed?
Yes, I do. When you think about the Fed and monetary policy, they're running the same monetary policy as 13, 14 months ago. And in the meantime, both the healthcare response and the fiscal response have far exceeded what anyone imagined back then. So I don't understand why they need to keep doing this. One of the things that we looked at recently was just the aggregate dollar amount of GDP in the U.S. It's at a level that's pre-pandemic. So think of that for a second. You've got the same aggregate dollar amount of GDP in the last quarter as you had pre-pandemic, and you've done it with 8 million fewer people being employed in the workforce. So there's a huge amount of acceleration in the pipeline coming.
Isn't that the point, though, Bob, that we've still got so much more work to do in the labor market, and they won't want to change anything for the next several months? Because as far as the Federal Reserve's concerned, once you start one part of the sequence, people start thinking about the next part of the sequence, and you start pulling forward a whole range of issues.
But you know what, John? We're grown-ups. we can understand it and we can absorb it. There are 3 data points in the last week that are an interesting intersection. The first are the Fed minutes. They explicitly put in there a discussion on tapering large-scale asset purchases, contrary to everything they've said publicly. So they put that in there for a reason, to begin the dialogue. Secondly, you go back to one of Alan Greenspan's favorite indicators of inflationary pressures, vendor deliveries. When you look at the subcomponent of the Philly Fed index on vendor deliveries, it's registered its all-time high going back to 1968, and then something Mohammed referenced. You start looking at wages. And you know, a couple weeks ago, it was McDonald's, Chipotle. What was it this week? It was Bank America. Minimum wages are going up. That's becoming embedded. And those are the kinds of things that employers need to do to attract workers going forward. All of those are inflationary pressures. So the Fed is right to start the conversation now.
I've got an economist next to me called Michael McKee who started laughing when you said we're grown-ups, because Mohammed, many times the Federal Reserve has treated the market as if it's a toddler, and the market in many occasions has behaved like a toddler, which makes me ask you the question, Mohammed, how you think the market will respond to the taper discussion deeper into summer?
So I think it depends when they engage on it. If they engage on it now, I think it will be minimal effects. The longer they wait, the more the market is going to worry that they're going to have to accelerate some sense of normalization, and then the market will worry. Look, John, there is a history here. We know when the Fed gets behind, the likelihood of we ending up in a recession is very, very high. So that's why it's better to embark on it now. There's enough evidence. And I want to stress, this doesn't mean you downplay the 8 million people who still haven't gotten back in the labor force. We all want them back. But it's not a demand issue. It's a supply issue. And the Fed cannot alter the supply dynamics by simply keeping monetary policy too loose.
Bob, your worries, the mid-2000s, the mid-90s. It's kind of what Mohammed's alluding to here, isn't it?
Yeah, it is. And I said that, you know, maybe I'm scarred by the 94 experience, because going into the tightening cycle in 94, where they raised rates 7 times by 300 basis points over 12 months. So they went from 3% to 6%. Going into that period, they were looking at GDP that was printing 4 to 5.5%. They were looking at core personal consumption expenditures that were printing north of 2.5%. And they just ignored it because they wanted to make sure that the economy had recovered from the S&L crisis. And of course, we now know that that excess liquidity bubbled up in places like long-term capital and then ultimately into the dot-com bubble. They need to move now.
Mike McKee alongside me this morning. Guys, let's turn to Mike McKee right now. Morning, Mike.
Good morning, John. Well, in terms of policy, it is all about inflation for the Fed. Their bet is that they can be lower for longer because they think, well, temporary. Can I say temporary instead of transitory?
You can use a different T word.
Change the dialogue a little bit. And the markets are kind of giving it a sideways glance at the moment. You're talking about volatility, but you take a look at what's happening in the markets, and equity volatility has gone up a little bit in the past week as we've gotten this various information that Mohammed and Bob were talking about. But you look at bond market volatility, it's been falling. The bond markets have bought the Fed's idea at this point. So it looks like the Fed can keep going even if there are a lot of voices worried about things, because what happens if the markets react? Well, they pull forward the idea of when the Fed starts talking about tapering, but they'd already done that. Here's the Bloomberg survey that we took just before the last Fed meeting about when they would announce tapering or start to hint about it. Almost 2/3 say it's going to be this year. Third quarter, almost half say third quarter. That's the whole Jackson Hole scenario. So it's not like the market isn't telling us that they've got the idea at this point, and the Fed certainly can read that as well. Could they speed it up more? Sure. We have more jobs reports, but they could come in disappointing again as well. We have inflation reports coming up. We have the whole Biden agenda. As that goes through in Washington, we'll see how much money is involved in that and whether or not that worries people. And then, of course, return to the debt ceiling for those those of you who love that. So a lot going on out there between now and Jackson Hole at the end of August. But right now, the Fed doesn't see a reason to really change anything. They want to plant the idea that they could, but they don't want you to think they're going to.
Nominal yield's 161, and Mike, thank you. You talked about the lack of volatility in the bond market. Bob Michael, beneath the surface, looking at real yields, that's where the move has been this week. Break-even's actually rolling over. What did you make of the move this week?
So wouldn't it be funny if the Fed signals to the market a change in policy by Mike McKee actually going first in the Q&A and not last? So, you know, what do I think of real yields here? I think that the Fed is just sitting on the market. It's not necessarily the $120 billion in asset purchases that they're doing every month. It's about $300 billion a month in purchases that they're doing when you start to calculate all the reinvestment. So they can keep rates wherever they want them to be. And for now, they want it somewhere around minus 0.7% or so where we are currently. Am I interested in that? Absolutely not. You can't get me to touch negative real yields in the Treasury market.
I think there's a good reason why Mike's left until last in the news conference that we can talk about offline, Bob Michael. Mohammed, just a final word here, and we'll get back to the market in a moment.
It doesn't surprise me that the market is calm. I mean, think of it. If you are in a bar and they're offering you free drinks, and they tell you that maybe in the future they're going to stop offering you free drinks, you're not going to stop drinking now. So we shouldn't expect a massive market reaction until we actually have clarity how much they're going to, when they're going to start tapering, by how much, and with a view to what. Until that happens, the temptation is to ride this massive liquidity wave, and it is a very profitable trade.
Mohammed, Bob, sticking with us. Guys, stick around. Looking forward to the conversation on the other side. Let's get to the market desk just briefly, about 19 minutes away from the opening bell. Here's Abby.
John, we're looking at a second up day in a row after 3 down days earlier this week. A piece of the action deer. Shares are popping higher after the company put up a very strong quarter. Big beats on the top and bottom line. They also boosted the view on farm sector demand. Another earnings winner, Palo Alto Networks, the cybersecurity firm, very decent quarter. But the bigger deal, raising the revenue forecast, and of course, with all these ransomware situations, a reason to think that this space could continue to be on fire. Lots of green for the other cybersecurity names as well. And then finally, after 3 down days, energy getting a bit of a lift. This, of course, in sympathy with oil. The reflation trade, John, is back on.
Abby, thank you. Coming up, the US proposing a global minimum corporate tax rate of 15%. That conversation up next with Mohammed Al-Arian and Bob Michael from New York City for our audience worldwide. Good morning to you all. Equity futures doing okay on the S&P. We're up 1/3%. This is Bloomberg.
Market that
over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
We are going to see change across 2021 and 2022 in relation to how very large companies are taxed.
It looks very much like that we will have a solution in summer this year.
15%, the last proposal made by the United States, could be a good compromise.
This is the best chance and the best moment for having a global tax reform.
European leaders welcoming a US proposal for a global minimum corporate tax rate of 15%. The Treasury continuing its push for higher rates for multinationals, running in a statement the following, quote, "It is imperative to work multilaterally to end the pressures of corporate tax competition and tax-based erosion. 15% is a flaw, and discussion should continue to be ambitious." For more, let's head down to DC and catch up with Emily Wilkins. Morning, Emily.
Morning, Jonathan. How are you doing today?
Very, very well. Just walk me through the latest.
So yes, yesterday, I think you sort of hit on the big news that the U.S. is now proposing a 15% floor for a global minimum tax rate. Obviously, this ties very much into what the U.S. and the Biden administration is trying to do right now with their larger tax package. That proposes raising the domestic corporate tax rate up to 28%, although we could see that number go a little bit down depending on how negotiations go in Congress. And the idea is that to make sure that this higher corporate tax rate doesn't lead to a lot of companies trying to leave the U.S. and go elsewhere, the U.S. is also trying to establish this global tax rate as well. Of course, it's going to be interesting to see exactly how this plays into negotiations. Republicans have already said that they're not going to accept any sort of increase in the corporate tax rate because it goes against what they did in 2017 with their own tax plan. However, there's been numerous meetings this week between President Biden and Senate Republicans, and both sides have said that they still hope they can find some sort of path forward here.
It'll be very interesting to see if the Irish are willing to lift their corporate tax rate from 12.5 to 15. We'll see. Emily, thank you. Emily Wilkins down in DC. Some final thoughts, a final word from Mohammed Al-Erian and, of course, Bob Michael with us as well. Mohammed, you've shared the views of Mr. Cooperman recently of being a fully invested bear. Do you still retain that sentiment? Is that still resonating with you as you look at this market?
So I was complimenting you, John, in the earlier conversations we've had a few weeks ago of getting Leon to say that. That is such a good way to capture exactly what's going on. Even those people who would be standing on the sideline are right now saying, you know what, I'm going to be fully invested because this liquidity wave is getting me paid. And that is the delicacy we face. This is not a balanced market in any way. This is a market that is tilted in a big way towards being long and being very long. And as long as it doesn't get caught offside, that's fine. But I thought that captured so much, John, and thank you for having that interview with him.
Well, thank you very much for watching. Mohammed, that's the view from you, the view from Lee, the view from you, Bob. Are you still fully invested here? Have you built up a cash position going deeper into summer, or do you still like what you see?
Well, it really depends what we're owning. So we like credit, we like high yield, we like bank loans because of the floating rate component, we like short securitized credit, and we like some of the emerging markets, particularly the currencies. We think there's some catch up there. Look, we're in a period where there's a tremendous supply of very cheap capital that's readily available. Asset prices always inflate with that kind of backdrop. So I don't want to fight it until the Fed starts to take the proverbial punch bowl away.
The team over at BlackRock have pushed the idea, Bob, that now's the time to raise a bit of a cash position as you work your way through summer and potentially come up against some elevated volatility because of the taper conversation. Does that resonate with you?
No, because then you've got to get two decisions right. One, you have to make sure that you are going to have a correction, and then during the correction, you have to make sure that you re-engage. And with the Fed generating this amount of liquidity, and now you've got the ECB pushing off tapering, there's too much capital around. I don't want to fight that.
You don't want to fight it. Mohammed, what would you do on the cash side? Just in terms of what's happened, as you would always say, will Treasuries offer me the risk mitigating characteristics that I need if we get a drawdown in risk assets? Some people are arguing no, and some people are arguing yes to cash. Would you make that argument, Mohammed?
So I would be sympathetic to cash if I am as large as BlackRock is. Look, I know what it's like to be at a multi-trillion-dollar firm. When you need liquidity, you don't get liquidity. So you've got to plan way ahead than small investors. So I'm totally sympathetic with what BlackRock is doing, and I suspect if I was in their position, I would do exactly the same thing.
Well, Bob Michael's a big investor. So, Bob, why aren't you making that decision?
As I said, and we've got trillions too, but every day I get asked by clients, where can they put some cash? Every metric of cash we look at looks high, whether it's money market funds, which have ticked back up again, or you start looking at institutional cash balances, they've gone back up, or you just talk to our clients in our private bank or institutional clients. Everyone has way too much cash, uncomfortably so, and they're looking for any pullback to put it into the market.
Bob, let me come back to you. What do you think the catalyst actually is then to draw down this cash pile that's been accumulated over the last 12 months, if it's not been the data we've seen already year to date?
I think it's just the passage of time. People took some profits. They're not getting the pullbacks they want. They'll get impatient. They'll start to put it back to work. And they don't see any accidents on the horizon. I think what's going on this month is the typical May anxiety. Everyone now is so focused to sell in May and go away. It's the first thing people bring to me during a conversation with a client. So I think it's just anxiety levels out there.
And we do it every single year. I'd like a final word from you both, just on what you're looking for through the next couple of weeks. Mohammed, first to you.
So we've got to keep an eye on the inflation debate. I'm sensing that more people are open-minded now. We started this process with the majority of people in the transitory or temporary camp. Now people are saying, you know what, there's enough data to suggest that I should be more open-minded. And the big question is, when will the Fed and the ECB get there?
Bob Michael.
Yeah, I want to listen to Fed officials. They've got a week or so here before they go into their quiet period before the next FOMC meeting. I want to know how they're evaluating inflation.
Gents, thank you. Always appreciate the catch-up. Bob Michael of JP Morgan Asset Management, and to Mohammed Al-Arian out of Queen's College, Cambridge in the UK this morning. Thanks, gents. From New York, coming up, the morning calls, and later, crypto's wild week continues. The Treasury calling for stricter compliance with the IRS. That conversation just around the corner. On an equity market with Wall Street's biggest bull, Jonathan Collop of Credit Suisse and Etsy Dweck of Natixis. Futures up 0.4%. This is Bloomberg. About 5 minutes away from the opening bell in New York, we're positive 18 points on the S&P, up about 0.4%, down just a little bit on the week coming into Friday to take a bite out of that at the opening bell at 41.73 on the S&P. For the broader market, this is the setup right now. Nasdaq futures up about 0.5%. FTSE 100 totally unchanged. Appetite just starting to build around UK equities, the cyclical component of them. The equity benchmark in Frankfurt, Germany, the DAX up by about 1/3%. Another big winner this morning, Deere, with a nice forward look. The outlook brighter for Deere this morning. We'll touch on that mover in just a moment. That's the market. Let's get some morning calls. A look at some of the analyst recommendations this morning. We begin first up with a call from UBS upgrading AT&T to a buy, a $35 price target. The analyst seeing an attractive risk-reward profile following its deal with Discovery. Your second call from Bank of America cutting its Tesla price target down to 700, a neutral rating. The analyst expecting headwinds to get new funding after the stock's recent declines. We are positive there by 1.5%, call it 1.7. And finally, Northland Securities downgrading Seagate to market perform. The analyst seeing a volatile road ahead with shares trading in sympathy with cryptocurrencies. We're down there by about 1.3%. Coming up, Elon Musk, China, and the Treasury. Cryptocurrencies limping into the weekend following a week of volatility. That conversation is coming up shortly. And on the equity market, Jonathan Golliver, Credit Suisse, and Essie Dweck of Natixis from New York. This is Bloomberg.
Particularly, sort of the technology landscape have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
24 seconds away from the opening bell in New York this morning. Good morning. Your equity market shaping up as follows on the S&P with positive 0.4%. Some outperformance on a Russell. The small caps up by about 0.9% this morning. A nuanced, more constructive view over at Morgan Stanley. It's subtle. We might touch on it a little bit later. The Nasdaq up about 71. We advanced there 0.5%. You can hear it, and that's the opening bell. Switch up the board. In the bond market, we look like this on 10s. Yields in a basis point to 161.31. Euro dollar, euro negative, a break of 22. 122. We're lower to 121.94. We're down about 1/3%, and crude higher. Adding about $1.60 to WTI, up 2.5, call it 2.6%. $63 and about 50 cents. That's the cross-asset story at the market desk with your movers. Here's Abby.
John, the dip buyers are out this morning. That means the S&P 500 is headed to a weekly gain. The Nasdaq is headed to its first weekly gain in 5 weeks. So let's take a look at what's really driving the scene this morning. That, of course, is big tech. We're not looking at huge gains, but we're looking at nice follow-through to yesterday's rally. Apple, Microsoft, Amazon, Tesla, all higher. This, of course, as yields are down slightly, taking away those valuation concerns. Interestingly, though, we also have the reflation trade working. Energy is up for the first time in 4 days in sympathy with oil. So you have some of the big energy names climbing higher, and banks as well. Even though yields are down a little bit, you have banks climbing as well. So big tech, energy, finance, banks all higher, John, adds up to a risk-on day.
Abby, thank you. 60, 70 seconds into the session, we look like this on the S&P 500, up by 0.4%. Energy snapping back up a little more than 1%. Real estate, bottom of the pile, down 0.1%. That's the broader story for the equity market. Elsewhere, crypto, been a big story for you through the week. Bitcoin finding its footing as it limps into the weekend with a second consecutive week of big declines on the table here. The Treasury delivering the latest blow to crypto markets, announcing transfers over $10,000 will need to be reported to the IRS. For more, here's Bloomberg's Kaylee Lyons. Hey, Kaylee.
Hey, John. Well, we know the Biden administration has been looking to crack down on taxes, and lo and behold, cryptocurrencies don't seem like they're going to be immune to that. As you said, the IRS proposing applying these rules to transfers over $10,000. So essentially the same rule that applies to cash transfers. And the Treasury and IRS said that this will minimize incentivizing a shift in income. And it also warned about cryptocurrencies posing a significant detection problem by facilitating illegal activity, including tax evasion. So add the IRS onto a laundry list of potential headwinds and negative catalysts we've seen for Bitcoin over the last several weeks. You also have the constant Twitter musings of Elon Musk, his U-turn on allowing Bitcoin as a payment for Tesla, the PBOC warning on cryptocurrencies, and really just a broader deleveraging we have seen. So yes, Bitcoin has stabilized above the 41,000 level now, but that's after falling as low as $30,000 at one point on Wednesday. And of course, it is down by the better part of 30% over just the last 10 days. So that is a lot of volatility, a roller coaster ride to the downside for an asset that many have been trying to claim can serve as a portfolio hedge, maybe throwing a little bit of cold water on the thesis that this can do a good job of protecting you against inflation, or that it can do a better job in that effort than gold can. I would just point anyone making that argument to this chart here at GTV Go. Shows us the 60-day volatility of Bitcoin. That is in yellow. It's now at a 64 handle. Obviously, it's creeping up. Gold volatility, on the other hand, going down, John.
Kaylee Lyons, thank you very much. What a story for me through the week is just how well priced things are right now. The demand hopes and the supply worries. So take Macy's, coming out with a blowout quarter, great numbers. Stocks ran up 70% going into the numbers themselves, and then the stock trades lower even with a better forward look. Take Cisco, which has got the supply shortage, the supply concerns, the profitability concerns looking a year out, a stock that's lagged the market. They come out with the earnings. Not fantastic. Stock trades positive. Just how well priced are both the hopes and the concerns? The hopes of a Macy's and the concerns around a name like Cisco. Joining us now is Jonathan Goldberg, Credit Suisse, and Esti Dweg of Natixis. Let's start there, shall we, Esti, if you can. Macy's come out with great numbers. Stock trades negative. Cisco comes out with concerns, stock trades positive. It's a single day, I know, and I'm cherry-picking data, so forgive me. But I just wonder how well priced these concerns and hopes are at the moment.
Well, that's one of the questions. We've seen in the last few weeks and months a lot of the froth come out of the market, some of it in crypto, as was just discussed, in the SPACs market, in the IPO market, some of the clean energy. We've seen really a trend of some of these coming off the peaks. And when you take a step back and you look, the S&P 500 still close to all-time highs. It's held up pretty well. We've seen this rotation within, and there's really a lot of hope for the reopening and early expectations that that guidance is going to continue to be good and that we're going to get better news throughout the year. And of course, the view that potentially you're rotating out of the more growth technology stocks as this reflation reopening takes place. So we think there's more room to run in this reflation trade. But at the same time, I would keep an eye out for treasury markets because yields haven't moved the way might one have expected them to move given the inflation numbers of the last couple of weeks.
Nominal yields right slap bang on the average of the last couple of months on a 10-year in around 161, 162. John, your take to that if you can. Just the earnings one, but how they've responded, how the price action, the market has responded in turn. What's the information there for you?
Well, it's a question we're getting every day. The earnings beat expectations in the first quarter earnings season by 22%, and the price response was something like 50 or 60 basis points positive when a company was beating on both revenues and EPS. And people are wondering whether that means that everything is priced into the market. I think that's entirely the wrong way to look at it. The market's responding to what we call factor risk. What they're looking at is, are these is it a bank that's sensitive to reopening or interest rate moves? Is this a energy company that's sensitive to commodity prices? And right now, it's those macro risk exposures that's dominating the move. So it's not that the stocks are numb. It's not that the market is discounting everything. The market is really trying to calibrate how big is the reopening, who's going to be a play on that, how long this goes on. And I think the market's extremely sensitive. But the one quarter's earnings announcement is not what the market is focusing on, and I think that's the right way for the market to be thinking about things.
So a question for you both, and John, I'll come to you on this because I know your view on it. Do you disagree that peaking growth and peaking growth rates represent a headwind for market success from here?
You want me? I'll go first. I think that we make a mistake to think that things that continue to rise aren't growing if the speed is renormalizing. We're going to see a 12% GDP in the second quarter or something like that. That's the Bloomberg consensus. Our estimate for EPS growth in the second quarter is 75% versus the prior year. Do I expect the third quarter to be bigger than that? No. And do I need a third quarter to be bigger than that for the market to continue to go up? Also no. As long as things are progressing, as long as things are healthy, things renormalizing to healthy, more moderate growth is perfectly fine, and it'll be enough for the market to do well. Will we see, 70% growth in the next 12 months like we've seen in the last 12 months? No, but we could see 10 or 15%, and that's probably a terrific outcome.
Esty, do you share this view?
Completely. I agree entirely. And I think you have to look at things from where we started. And okay, this has been a very quick cycle, but we're recovering from such a sharp shutdown across the world that there's plenty more reopening to go. I wouldn't look at ISM or PMI levels right now and say, oh, this is the peak, and historically it hasn't worked. There are a lot of other factors at play. Growth doesn't need to be at these levels. I completely agree. And when we think about it, there's plenty of reopening left to go. I mean, the U.S. is in advance in terms of vaccinations, and still a lot of the restrictions are in place across a lot of states. Europe is lagging by a couple of months. The rest of the world has been even slower, and there's a big question here for the emerging markets. We're starting to talk about travel corridors, reducing capacity, removing a mask mandate doesn't really reopen everything entirely. So there are plenty more steps and plenty more room to grow. And expectations for earnings remain very buoyant for this year and for next year. So no reason to think the market needs even more of this incremental growth to keep moving forward.
Esty, you mentioned Europe, though. There's plenty of scope for catch-up in the data. We've seen that in the PMIs this morning, just fantastic through Europe and the UK as well. And we'll touch on it a little bit more later when we get the US PMIs in about 6 minutes. But the market's not exactly lagged in Europe. When you look at the S&P 500 banks, up 30%, 40% in some places. European banks are up 28% year to date. Are you worried, Esty, that maybe some people are looking at the data, which has lagged, and believing that the market hasn't, believing that the market has too, when it actually hasn't?
I don't think so. I mean, we've seen the market hold up, especially in a number of sectors. And of course, it's also a slightly different picture if you look at the S&P 500 equal weighted index versus Europe versus the overall index, and obviously some of those challenges technology has had more recently. Data in Europe has been better than expected and more resilient than expected despite ongoing restrictions. But it's not surprising to see the PMIs move much higher now, because vaccination has finally accelerated in the past 6 weeks or so. It's really picked up in Europe. People are getting their vaccines. You're starting to feel the optimism. This vaccination passport is kind of confirmed at this point throughout Europe. So people are going to get a summer vacation. That's going to be good for tourism, good for a lot of economies. And again, the market's done quite well. So there are plenty of sectors that can continue to catch up. Banks really benefited from the move in yields and from the ECB protecting the sector as much as possible. But there's room in other sectors to continue to move up.
Esty Dweck, we'll continue this conversation alongside Jonathan Golub. Your equity market up about 0.6% on the S&P 500, now positive on the week. I promised you that note from Morgan Stanley's Mike Wilson. Just a subtle move around the small caps following 2 months of underperformance that they got in front of. They say the following. This quote here: the Russell likely still has downside as the S&P 500 and other major averages continue to re-rate, but we just think it will occur in a more uniform manner now. So it's not the looking for relative underperformance here. It's just a uniformity about what they're expecting clearly over at Morgan Stanley, with Mike Wilson leading the team there on the equity side. That's the market. That's a call from Morgan Stanley. Let's get you to the market desk with Abby for more. Hey, Abby.
Hi there, John. Well, let's take a look at some movers in 3 of Jonathan Golub's overweight categories. Starting out with discretionary, we have some specialty retailers rising on very strong quarters. Foot Locker beat. They're saying that momentum gained strength as the quarter progressed. Decker is having its best day in about a year. Their sales forecast was raised. Analysts saying this is not just a stay-at-home name. And the Buckle sales more than doubled. As for energy and financials, we have some strength there too. Even though yields are down, banks are up, and energy, big energy, higher with oil, John.
Abby, thank you. Coming up, breaking U.S. economic data about to cross the wires. Another round of U.S. PMIs coming up in just a moment. From New York, this is Bloomberg.
Generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Traffic. Okay.
During the pandemic, no traffic at all.
Okay, where do you see the oil market in about 20 years or so?
Non-existent.
There is a big number with your PMIs. Here's Mike McKee.
Yes, indeed, John. The PMIs from market services industries, 70.1. That seems to be the highest ever in the history of the series. It is up from 64.7, and it's 6 points better than had been forecast by the economists going into this. The market manufacturing PMI is at 61.5. That's a 5-point gain over the prior month. And the composite comes in at 68.1. And let me just double check that, because that may also be a record. The way we're going now, these numbers are just amazing. Now, the thing to keep in mind, of course, is that these represent the difference between how purchasing managers were feeling last month and this month. And obviously, we've had a lot more reopening. And so it is more likely that they're going to feel better about it. This does seem to be, the composite does seem to be a series high as well. This follows what happened in Europe, and I was going to say April showers bring May flowers, and the economies are flowering in Europe. They're all seeing higher gains, except for manufacturing in services, rather, manufacturing in Germany, which is down a little bit, but they're in the 60s. And so all the European nations are showing the same kind of growth for services, manufacturing, and the Eurozone overall is showing the same kind of growth. You can see the numbers there. So it's looking like the world is coming back from the pandemic and coming back rather quickly. These numbers don't suggest inflationary pressures. We don't have the detail from them, especially in the U.S., but it does suggest that it's something to keep an eye on.
Mike, just for the U.S. numbers, have you seen the numbers around prices paid, the hiring, the issues that we've been talking about for the last couple of months? Are they alleviating in any way, shape or form?
They don't seem to be, although we're getting some early indications that maybe some of the input price pressures are falling back. The Bloomberg Commodities Index, the Industrial Metals Commodities Index have been dropping a little bit. And so if that's the case, then we're going to see a little bit less pressure in the pipeline.
Mike McKee, thank you. Just to recap those numbers, just a wow number on a PMI for services, Mike. To see a 70 handle in the mix, 70.1 on a services PMI, manufacturing coming in at 61.5, the composite 68.1, a preliminary reading for the month of March, but up from 63.5. That's what you want to see. A better economy, and that's the outlook, at least the view of where this economy is right now for those conducting this survey. Let's bring in Jonathan Golubin, SD2X, for a little bit more on this. John, these numbers are incredible, and something that you've said on the earnings side, and something that I think some people struggle with. You can have a market that rips, but because the profit numbers are so good, you can have a valuation that actually comes in, even as that market rips. Can you run me through that, John?
Well, yeah, it's very simple. I mean, we measure the valuation of the market as a PE ratio. What is the price you're paying for $1 of earnings? And if you're seeing the market having earnings, expectations up 75% year over year in the second quarter, that's the EPS number, and the price is only up 50% year over year, well, then the market got cheaper. In the last, year or so, the market went from a 23 multiple to a little bit above 20, and yet was up by these massive amounts, because it's almost impossible for the stock market's price movements to keep up with these earnings. And SD before was talking about how strong things are in Europe, and you were kind of prodding her on that. but the European growth rates, because they have so much more in banks and energy and materials than the U.S. does, which are the hot areas, their earnings numbers are just ripping. And I think, as much as I love the U.S. market, that Europe's going to be even stronger.
You like Europe right now, John?
Well, listen, I love the U.S.
Well, clearly at 4,600, you love the U.S., but why Europe too?
I do. But if you look at the companies that dominate the U.S., it's intellectual property. It's tech names, it's consumer branded names, it's healthcare names, and those are not big winners in an accelerating economy. We don't go out and get another iPhone because the economy is strong and we get a new job. However, we may go on a plane and take a vacation. We do eat out more. We may upgrade our home or things like that. So the economically sensitive stuff in this kind of environment is all old economy, and Europe has more of that than the U.S. does.
4,600, by the way, is the year-end price target of Jonathan Golub that I was using just then. Not where we are right now, just where John thinks we will be year-end. SD Dweck in Europe at the moment, just in terms of getting that exposure to the better story, where do you go for it? Do you push it through foreign exchange, a long euro? Do you push it through the bond market, yields higher in the German part of the bond market, in the core? Where do you do that? Where do you push through that more constructive view?
Honestly, more in the equity market. I think we've already seen the euro